Places right now. We're seeing it play out in France right now. We'll see it play out in the United States later on this year.
Let me go back to the macro story as well. When you think about what is happening, central banks are taking a risk going in front of the Fed. I don't think it's been a big risk yet, but if it continues, does that attract flows into the United States, which ultimately benefits equity markets over in the United States more maybe than Europe? Markets are open here in Europe. Here we go. Again, I struggle to apply a narrative to the session. The FTSE 100 is rising a little bit this morning. I think we're expecting, what, 0.3% to the upside in terms of well, Anna, we get a woohoo from Anna. It's a very sort of diluted woohoo,
yes.
though, I think.
It was a slightly ironic woohoo, I think.
Probably
a cautionary woohoo, if we will. Fairly broadly in the green, which just, I think, signifies that kind of buyback or a bounce back that we were talking about initially. Guy doesn't find a narrative, but I've got to say, one of the smartest people I know at Bloomberg, Cameron Christ, is the author of the Macro Man column, once told me sometimes traders trade because they trade, and I think that's the narrative for this morning.
There you go.
Yeah. And it's funny how journalists sometimes apply narratives that the market just is slightly scratching its head about. Nice to see a narrative.
We try.
We've always got to apply a narrative to what is happening here. Here you go. There you go. Market's up by 0.3%. Let's call it 0.4% to really kind of push the woohoo as far as it'll go this morning. Banks are not bouncing back. Banks are up by 0.1% this morning. That is maybe one of the big takeaways from today. But technology is not rising. We've got very few stocks in negative territory. Very few sectors in negative territory. Telecoms are down. Travel and leisure is absolutely flat as we speak. I think the market's kind of digesting yesterday and bracing for tomorrow.
Yes, I'm just looking at where we are on commodity prices this morning, because I see basic resources is one of those only sectors that you mentioned in negative territory. We did have a bit of weakness overnight, I think, in copper prices, and I see that Rio Tinto is one of the stocks that's a little weighed down.
One of the stories that's kind of passed us by, I think, as we focused on the politics over the last few days, has been this bounce we've seen in oil prices, which I think is something you need to factor back into your thinking when you think about what is going to happen with inflation. There was this expectation as oil prices started to track lower that maybe that was going to augment the disinflationary trend. That has now reversed reasonably significantly. So I think it's interesting now that we do see that.
Yeah.
And commodity prices are reasonably stable. So you're not going to get that kind of inflationary help coming, or disinflationary help coming there.
Yeah, crude really rallied yesterday, didn't it? Yeah. As traders, according to colleagues, were buying the dip after the biggest weekly loss since early May, following that OPEC Plus report. I remember it took a while for markets to get on board with that bearish interpretation post OPEC Plus. They did very much get on board with that last week, and then we saw a bit of a bounce back in oil prices yesterday. Kind of holding steady this morning, down 0.1%, but 81.53. So once again, that's our Brent price, of course. So 81.53 is where we trade on the Brent price this morning.
So I want to have a look at Atos and see how it's trading this morning. If it's trading this morning, I wait. There we go. We're positive, up by 1.8%. It's bopping around a little bit all over the place. So Atos, a positive response to the restructuring news that we've had out this morning. Now it's up by 3.5%. So there's a little bit of volatility in the Atos share price this morning.
There is, and there's two other stocks I'd like to mention. SocGen is one of them, where of course in terms of the kind of the bounce back as well. But the reason I bring extra attention to SocGen is because overnight some reports coming out that they weren't able to agree with State Street on a price for their custody unit. So we're going to be monitoring some of those negotiations. And speaking of negotiations as well, one of the downside movers catching my eye is AP Moller Maersk. It's coming after dock workers over in Boston and Houston, halting some of those labor talks. So it kind of feels like some of the narrative there is feeding back into the share price. So a couple of stocks to watch on that front.
France isn't bouncing back that much this morning, though, is it? We're up by 0.4 of 1%.
Kind of on a par with the FTSE.
Yeah.
It doesn't feel like this is a convincing bounce back.
No. A cautionary woohoo for sure when it comes to the bounce back. But I wonder if that's just a matter of kind of getting your feet wet a little bit when it comes to the broader trade.
Let's talk a bit about what we talked about yesterday. Chris Watling joined us from Longview Economics. This isn't what he had to say.
The growth comes because of expanding banks' balance sheets and more credit, then governments get money anyway. They don't need to do that. We're so lost in this 15 years of dreadful, dire growth. No, I think governments, you're right about buckets, but if the whole pie's expanding, it doesn't matter. The markets have got a lot of momentum in big cap tech, so you've got to time the turn. But
you'd buy the European dip this morning?
I mean, it depends on if you're a long-term investor, absolutely. Buy Europe all year this year.
Buy Europe all year this year. Chris Watling, CEO and Chief Market Strategist of Longview Economics yesterday, joining the team. Ewan Monroe, CEO at Newton Investment Management, joins us now. Let's get his take on that. Buy Europe, you a big fan of the Buy Europe trade?
Well, I mean, obviously it's adjusting to the renewed uncertainty to the election in France that wasn't expected. Yep. So whenever you get a sort of new factor thrown into markets, they make an adjustment. That's what we've seen. I don't know if it's as simple as just geography. I mean, I think there's definitely been huge leadership by US tech companies. Yep. And I think we all look at the valuations and wonder, are they sustainable? And a big part of that narrative of why they're so expensive is the growth of artificial intelligence and cloud. But the story that they're telling is that's going to impact every sector, bringing efficiencies and improving profitability. So looking broader and saying who will actually win from utilizing AI, not selling it to everybody else, does bring you to Europe, does bring you to some other geographies. So I do think we'll see a broadening out of I think we're starting to see a broadening out of...
Do you have to see a broadening out for this equity rally to continue?
I think you do, because the whole narrative of the tech giants is that everybody's going to be using this technology. They're going to be prepared to spend money on it because it's going to help them improve margins, efficiency, etc. So if that doesn't happen, they're too expensive, and they're going to fall back. If it does happen, then maybe we'll start seeing other winners emerge.
Ewan, it feels like in the last couple of days especially, we've been talking a lot about public finances in a way that markets haven't been as sensitive to, I want to say, in the last couple of months, really until the third quarter of 2023, when, of course, we had that sell-off on the long end. How do you price that?
Yeah, I mean, I think markets are sensitive to it. I mean, you know, it's been this year we've seen, you know, the market pricing out a whole load of interest rate cuts in the US. I think now people feel there's maybe only going to be one this year. And where you've got an economy in the US where they're effectively, you know, spending money, 6% deficit at a time when, you know, borrowing $1 trillion every 100 days. Yeah. And then also, have quite tight monetary policy in a sense. Those two counteract each other, and the market's recognising that by just refusing to let treasuries rally to any extent. So I think there is a recognition, and so I think probably the market's broadly got it right. Post the US election, I think they have to do something about the borrowing situation. I don't think it's sustainable. I think,
what's the doomsday? I mean, what is the worst that can happen if January 2025 rolls around, they hit the debt ceiling? What do markets do?
Well, I mean, the situation at the minute is they're having to attract borrowing from foreigners. So the US takes in, you know, it's got a sort of international trade sort of funding imbalance, and so there's this $1 trillion every 100 days that has to come from foreigners essentially to fund them. At some point, if that gets rejected, you're going to see something like a UK crisis that we saw with the Truss government, where, you know, we get a rapid move in bond rates, a failed auction or rejection, and that will be bad across. You'll see a strong correlation between equities and bonds in that sort of scenario.
Ewan, thinking about, I mean, you referenced the UK there, so let's go to the UK conversation. I was reading the Markets Live team here at Bloomberg has done a survey of their readership, and it suggests that the readership there says a big majority for the Labour Party, and obviously the polls tell us that the Labour Party could win in the election on July 4th. If we get a big majority, then that would be good for stocks, according to this survey. What is the relationship, do you think, between the size of a mandate that we get for a political party and what stocks will do? Because I'm thinking in other geographies, other times, I've heard conversations that say, you know, gridlock's actually good for stocks. And now we seem to be running with a narrative that a big mandate is good for stocks. It seems easy to argue in a number of different directions.
Yeah, I think it depends on the nature of the mandate. So I think the mandate that Keir Starmer is asking for is essentially a mandate to do very little. So he's very, very scared to rock the boat. He's not going to, you know, put up taxes, etc. So there's all these commitments. So I think when you have a large majority on a relatively safe-sounding mandate, the markets aren't going to get too excited about that. I think it would be very different if, you know, there was going to be a huge majority for the Jeremy Corbyn mandate. Clearly, that would have had a much bigger impact on markets than what we're facing at the moment.
Yeah, and we're in a week where we're going to get a lot of manifestos coming through. We've already seen the Liberal Democrats one. We're going to get the Conservative Party manifesto soon. I mean, for an investor, what are the things that you're going to be crucially looking for, either in terms of what it does to the UK economy, what it does to UK risk assets, or what it does to the financial services sector? What are you going to be watching for?
Well, I think obviously procurally, I think you know, I would want a government that's supportive of the City of London and financial services. I think that was something that was largely forgotten during the Brexit era, and it is a really important industry for the UK. And so I would want to see that there was strong support, and all the noises off are indicating that there is going to be that support. More generally for the economy, I think we need to see some, you know, serious investment in our infrastructure. And I think there hasn't been that clarity in politicians' discourse about borrowing between what are you doing to borrow to pay, you know, benefits and so on, and ongoing costs like the NHS, and what are you borrowing to actually build productive infrastructure into the economy. And the two have very different long-term effects. So I would like to see a government that was bold about infrastructure for the UK.
It sounds like you don't think you need to hedge political risk in the UK because you don't think that any of the parties are sounding that bold in terms of what they're suggesting. But broadly around the world, we are seeing political risk causing problems for markets. I look at South Africa, India, obviously the dip there bought, but nevertheless significant volatility. We're building up to the main event, which is going to be the US later on this year, but we've now got a French election to throw into the mix as well. How do you, in your portfolios, think about how to hedge that risk? Yeah, well, I think we have to build diversified portfolios all the time. But diversity is underperforming. Your point about tech, diversified portfolios are massively underperforming. So what do you do? Yeah, well, I agree, but I think the responsibility of an active manager is not to be too short term, is to look through. And it can be tough at times, because I think you're right. You know, portfolios that are highly concentrated on a small number of stocks have over-delivered over the last little while. I don't necessarily think that's a responsible position for people to be holding. So I think we have to risk a bit of underperformance in order to get proper diversification.
And when you're thinking about where you diversify, and let's take the long view on markets, I take from your notes that you provided before the conversation, you don't think we go back to rates that are like the rates of the post-GFC inflation. Maybe does inflation not even revert to levels that we saw then when inflation was low? What are your expectations for the rates environment from here?
Yeah, I think rates will gradually drift down, but there'll be nothing like back to the levels that we saw in the 10 years after the global financial crisis. And so I don't think we're going to get a big interest rate declining surge for risk assets. I don't think they're going to be particularly helpful, which, again, what I say most times I'm here in other forums, is we're going to have to get used to making money the old-fashioned way, which is compounding over time. It throws
out opportunities as well as providing risk.
It does. And so there are really attractive markets. You know, the UK isn't the only market that's talking about stock market reform. We've seen that in Japan. We've seen it. I was recently in Korea. There's a value up initiative there, and so I think sort of looking a bit broader about where the opportunities might be, and investing in companies that don't have too stretching valuations is the best way to survive this period.
Ewan, thanks very much. Thanks for joining us. Ewan Monroe, the CEO of Newton Investment Management.
Core 6 looks like this. These are the core stocks around Europe. These are the kind of stocks that really make a difference in terms of their weightings across the continent. You can see broadly a little higher this morning, not by a lot, but a little higher. Nestle, interestingly enough, the more defensive end of that group, certainly a little softer this morning, but broadly elsewhere we are seeing some strength. Let's talk a little bit about Atos. Atos initially went up. Now it's gone down really sharply. In fact, it's just been halted. Let's get some details here. Joe Easton, what do you got?
So as you say, Guy, Atos did rise at the open, but we're now seeing a massive drop, down 10% in a trading halt, as you say. Now, the company has agreed to a takeover from OnePoint, another software company. But as part of that deal, 2.9 billion euros worth of debt will be converted into stock. I've just read a note from a bank called CIC over in France, and they say that this does mean heavy dilution for existing investors, and as a result, it is being taken negatively. As we can see, a nice big round, down 10% on the screen there in a trading halt. We'll keep an eye on where that moves when it reopens in Paris, but it's the dilution of existing shareholders that's the concern for that one at the moment. Then we'll take a look at miners, a 4% drop in iron ore futures at the open of trading. That caught my eye earlier today, and we're seeing a read-through into the mining stocks. Rio Tinto, Anglo, Glencore, Anto, all in London and all down. Rio down pretty sharply, down 2.2% this morning, affected by that drop in iron ore. That's being pointed on the Chinese property market. Once again, concerns around that. There was a long weekend holiday there, and that is hitting the market as it reopens on that market as well. I think we're going to look at France because we did have all that focus yesterday. We were expecting some rebounds, but we're only seeing Eden Red is a company that does food vouchers and employee vouchers exposed to government contracts. That is rebounding, but the rest of them can't catch a break. The ones exposed to government contracts, Airport de Paris, Vinci as well, the airport operator, SocGen, the banks, still declining. That legislative election weighing on the macro outlook for France at the moment. Then speaking of macro outlooks, we'll look at UK home builders because they are rallying following that UK wage data. It is easing. Now we will get a Bank of England rate decision next week, but the day before we'll also get CPI from the UK, so there's still a lot to play for, but wages are easing ahead of the Bank of England is positive for home builders. Bellway, Crest, Persimmon, Taylor Wimpey, all of them seeing decent gains this morning. Then another one in the UK, another sector to look at is the staffing firms, because Exane BNP Paribas is calling the bottom of this market. They say that the staffing companies have underperformed more than they did during the financial crisis in this economic downturn. They say it's gone too far, and those companies like Page Group should be getting a boost. They upgrade that one to outperform and getting a nice rise up 1.8%. Finally, another broker move, this time in tech. BE Semi, the rival to ASML, the chip manufacturing company, the semiconductor industries firm. That one's upgraded. This one is over at Redburn. They go buy on that one. Actually, the price target below where it's trading now, but nonetheless, gaining 3%. Positive sales update from them last week. That one is gaining in Amsterdam today.
Joe, thanks very much. Joe Easton from our equities team with a rundown of some of the stocks on the move. He's right to point out Basic Resources and the underperformance there. That one of the few sectors moving decisively this morning. That's down by 1.5% for the mining sector in this morning's session. Talking of decisive, we see the Bank of France's Villeroy saying the ECB rate cut marks a decisive orientation. This in the context of Christine Lagarde giving a slightly more measured language around what that cut that we saw last week means for the future of rate policy.
It's interesting that you mentioned that, because I was just looking at the bond market as well. You are seeing a bid into every single bond market in Europe, except for France, selling off by about 5 basis points this morning.
Citi's out with a note this morning talking about the fact you don't want to buy French debt until you see the Bund OAT spread going to 65 bips. We're at 55 now. There's some action, therefore, still to come, potentially in the widening. Yeah. Basically, the expectation would be that a Le Pen led government would basically spend more.
Yeah, and Deutsche Bank actually coming out as well and saying 40 basis points instead of 65 on that. And actually saying what I thought was interesting with that report, that the rating downgrade doesn't reflect the twin deficit. They're actually saying it's worse than the rating downgrade suggests.
Yeah, it's interesting that some of the comments we've been having about preference for European government bonds don't seem to place too much concern on that. You know, would a government run by Marine Le Pen, would it spend more? And others do. Others say that's decisive.
There is this huge argument, though, which Europe is still grappling with, which is, do you spend more money and actually get a better result? look at the United States. Why is the US economy outperforming? Now, there's kind of structural reasons for it, but there's also the reason that the government is spending money like it's going out of
And
fashion.
in a very different geography, Ewan Munro talking to us about how in the UK he wants to see investment in infrastructure, drawing that distinction that's been, you know, drawn age-old distinction in financial markets between borrowing to invest and borrowing to fund the day-to-day, which sometimes gets so confused in the politics.
Yeah, which comes back to the point that you made, I want to say a couple months ago, about the fiscal spend in Spain and Italy as well, in terms of the outperformance that you're seeing. Italy, again, winning that case.
Yeah, the peripherals that were so underappreciated now they're becoming a little bit more appreciated.
We need a different story. We have a different story this time around, don't we? It's certainly not 2011. Coming up on the programme, Apple debuts its long-awaited new AI tools. We'll get a rundown of what we heard from Apple, what the relationship with OpenAI is going to look like, and we'll get Musk's response as well. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Recent developments in generative intelligence and large language models offer powerful capabilities that provide the opportunity to take the experience of using Apple products to new heights. Introducing Apple Intelligence, the new personal intelligence system that makes your most personal products even more useful and delightful.
That was Apple CEO Tim Cook on introducing Apple Intelligence at their developers conference. Apple has unveiled its long-awaited suite of new AI features, including a partnership with OpenAI, the maker of ChatGPT. The iPhone maker is betting that a personalized and understated approach to the technology will win over customers. It's a high-stakes bid to catch up with rivals in the booming AI market. So what did we make of it all? Let's talk to Matt Bloxham from Bloomberg Intelligence, who's been looking at the detail for us. Matt, good morning. So did the event do enough to boost sentiment in Apple's growth outlook? I mean, the stock, we were talking in the break, the stock sold off a little, a couple of percent, but it's been up a lot year to date. So what did we think it told us?
Yeah, that's right. I mean, I guess what, from around April, it's up almost 20%. So I think the market already moved in anticipation of this event. And I think it's betting to a degree that this is going to drive some kind of smartphone upgrade super cycle from September when the iPhone 16 comes out. And that's essentially the first device that's really going to be able to use this. I mean, the iPhone 15 Pro and Pro Max are capable, but that's the only one the current lineup. So I think there was a lot there, a lot to digest. It's a very slick, comprehensive set of tools and applications. It's going to enhance everything you do in the Apple environment: email, messaging, notes, all of it. But yeah, I think there was nothing there that wasn't very well flagged into the event. So there was no kind of incremental, wow, I didn't see this coming. That's kind of really added to our conviction. I mean, the market's expecting iPhone sales to grow about 6% next year. So there's an anticipation that from this kind of prolonged dip in iPhone sales, this is going to drive some kind of recovery. But I'm sure over the next few months, there's going to be lots of kind of swings around, whether this is really going to drive a stronger uptick in iPhone sales.
I'm just happy I'm getting a calculator. Let's talk a little bit about, on my iPad, let's talk a little bit about Musk's reaction, Elon Musk's reaction to this. He's talking about banning Apple products. He's concerned about the integration of ChatGPT into the software. Is that a legitimate concern, or is that the ongoing spat that he's basically having with Sam Altman and OpenAI?
Yeah, I mean, I think there's definitely a healthy dose of that. At least that would be my perception, because as you say, there's a long-running feud there. And obviously, Elon Musk is developing his own alternative to that platform. And this is obviously an opportune moment to kind of get some spotlight with Apple talking about this stuff. I mean, I think there clearly are legitimate concerns around, the safety of generative AI in general, and also the amount of data you're sharing as a user when you make a request of any generative AI platform, whether it's ChatGPT or anything else. And obviously, Apple's trying to kind of mitigate a lot of that. They went to great length just to say most of what you'll do as a user will be on device. And when it goes onto the cloud, they've got this new private cloud environment. And I think they'll take that into the ChatGPT relationship too, saying that your IP address will be masked and ChatGPT won't hold on to the request you make. So some specific privacy issues that Apple has set up there to kind of mitigate some of these concerns.
All right, Matt Bloxham from Bloomberg Intelligence, we thank you so much for joining the program, breaking some of that for us. And speaking of breaking down some of the tech story, we're getting some headlines coming out of China's foreign ministry. The EU's probe into EVs is trade protectionism, they say, saying there's no solid grounds for the accusations, and they won't sit idly by if the EU takes action on EVs. I believe we are expected to hear from them later this week in terms of the provisional conclusion of the EU probe. Coming up on the program, we can go right back to the markets. One of the world's largest market makers is entering the European rates market. We have an exclusive conversation up ahead with the global head of rates trading over at Citadel Securities. Michael DePass joins us to talk about how to play this market in both sides of the Atlantic. What deficit concerns do we have? What does the market plumbing look like? Liquidity, all that nerdy stuff and more coming up ahead. Stick with us. This is Bloomberg.
CFOs are reshaping the C-suite, Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
in terms of an attraction, German 10-year bunds and French oats, the 10-year there, their spreads have narrowed significantly in the past month or two relative to treasuries, and today as well by 8 or 10 basis points. So there's coming a point where European bonds are more attractive than treasury bonds, in my opinion.
PIMCO co-founder Bill Gross there echoing an opinion that we started to hear a lot this morning, where perhaps, especially in the context of the sell-off we saw in European debt off of the EU parliamentary elections, they may actually be a little bit more attractive relative to the treasury market. One of the largest market makers in the world in the meantime, entering that European rates market, Citadel Securities, planning to challenge the dominance of investment banks in the 10 trillion euro market. Joining us now for an exclusive conversation, I'm pleased to say, is Michael DePass, Global Head of Rates Trading over at Citadel Securities. Welcome to London. Thrilled to have you here.
Thanks for having me.
We'll talk about the business in a moment, but let's talk about these markets first. This is interesting that we're on both sides of the Atlantic. We're talking about deficit concerns, public finances. Of course, we know that the fiscal deficit in the U.S. is a looming issue on politics, on the election. It's a similar story here in Europe. How do you play it? How do you invest in that?
Yeah, so and it's a question that obviously a lot of our clients and a lot of our investors have been asking, and there is some concern around the growth and the speed of the growth in deficits that we've seen globally. But you know, investors continue to find value in bonds, particularly at these yield levels. We continue to see interest in both in U.S. debt, and our conversations as well point to significant interest in European debt. From the clients that we speak with. And I think that really highlights for us the focus and the reason why we're looking at getting involved in the European market is that it is a big draw for a number of investors, and there is real interest from our investor base for us to bring the kind of liquidity that we brought to the U.S. market over to the European markets.
I'm glad you brought up the liquidity story, because that's one of the concerns of why people, one, go to the U.S. Treasury market in the first place, and why they don't go to Europe in the second place. Talk to us about why that's even an attractive proposition at the moment when, again, we're talking about real weakness on this continent.
Well, for us, the idea is how do we bring liquidity to that market, right? How do we aid the market structure? How do we aid the market resiliency? And I think it's important to recognize that the European market has functioned quite well over the last few years, right? We've went through a very aggressive hiking cycle, and the market had no functioning issues. So for us, it's about how can we bring a differentiated type of liquidity, a tech-focused liquidity, to a market that maybe hasn't had that approach before.
And so you're expanding into European rates, Michael, which is really interesting. And you're doing some of that in Paris, I think. Talk to us about that Paris hub. It seems to be attracting, well, it's attracted you, it's attracted others, and some people draw a link with Brexit. But you tell me about what attracts you to Paris.
Yeah, so we're quite excited about our Paris office. We're going to be running our European rates trading operation and sales operation out of Paris. And it's a fantastic talent pool, a very technical talent pool, and we've been able to find resources, whether it's across sales, trading, or technology, that really quite additive to our business.
That's interesting. I was going to ask, are you having to take talent from London to Paris? But no, doesn't sound like it on a big
we've
scale.
made a few hires from London as well, but Paris in of itself is a quite deep talent pool.
And what are the plans around gilts?
So right now, we've done our first trade in sterling IRS. We'll be fully live in that space over the next month or so. And then I think if your ambition is to be relevant and a material player in the space, which for us it is, it's inevitable that you trade gilts. So get sterling IRS up and running, and then focus on gilts.
I think European politics, we're seeing a lot of volatility at the moment. Do you think it changes the attitude of businesses like you to where you do business in Europe, the types of governments that we're potentially going to be seeing formed? There's been a lot of, the Macron government has made a big push to attract a lot of people into Paris. There's a bit of volatility in French politics right now.
Yeah, the one thing I would say is that the European Union overall seems to be quite focused on its capital markets, right? So we're seeing a revitalization of a true capital markets union, a focus on making markets more efficient, a focus on improving liquidity, improving transparency. And I think politics are always a feature of markets and always something that have to be navigated. But certainly the underpinnings of the European Union, the underpinnings of the European financial system are quite strong.
Politics is starting to insert itself in a way that it hasn't until recently. You're seeing it with what we've seen in European government bonds, OATs yesterday. The gilt market probably is feeling a little bit more kind of comfortable with what is happening on the political front over here, but we've seen emerging market politics kind of upending markets in quite a significant way. We're all kind of building up to November, though. We're all trying to figure out kind of how markets are going to react and price in what we see in terms of US politics. Is that a conversation you're having now? Is that a trade that you would think about putting on now? Steepeners are super popular now, but they're not taking off. Is that a trade that takes off after the election? I'm wondering whether this is something that you are actively pursuing at the moment, or is it something that you wait until September, October before you start putting those trades on?
Yeah, I think you bring up an interesting point about the curve and the level of inversion that we've had for some time. I do think, even if you take politics aside, if you look at the setup in the economy now, you have inflation that continues to run above target. And we think that we have a Fed that's going to be very responsive to any weakening in the labor market. Those two things together, independent of politics, we think favor more term premium, favor a steeper curve. So maybe the political dynamic adds an additional tailwind, but separate from it, the macro setup for it does seem positive.
Are there liquidity concerns in the U.S. bond market right now, given the auction narrative that we're talking about, perhaps less demand coming out of China, Japan, et cetera, married with the fear of that kind of debt ceiling in January 2025? How liquid is the most liquid market in the world?
At the moment, it's quite liquid.
Too liquid?
And I would say, I don't think a market can be too liquid. I would say that we see significant foreign demand still for the U.S. Treasury market. That continues to be an important story and an important source of demand. And when we look at it, there are, of course, some concerns that exist in the market, but there has been a number of efforts. Well, I think to your point, can supply overwhelm the market? Are there issues with liquidity? But we've seen a number of steps being taken to improve market functioning. So a focus on an increase in transparency, a focus on an increase in central clearing. These things are all very good for market structure and really aid the functioning of the market over the longer term.
Michael, can't let you go without asking you about the very near term and markets and conversations with clients, what they're focused on. Clearly, we get data out of the US on CPI tomorrow. We get the FOMC decision, and some people are predicting we could see volatility in all kinds of markets as a result of those two things coming so closely together. What are conversations with clients like around that subject?
Yeah, so I think when we look at the inflation data in particular, there's a feeling that the volatility around those prints going forward is maybe going to come down. I think for tomorrow, the focus really will be on the FOMC, and in particular, what does the dot plot show for the number of expected cuts for the rest of this year? That number has obviously come down materially over the course of this year, and the market's split between, I think, somewhere between 1 and 2 cuts. So there'll be a little bit of a reaction, whatever the outcome.
How big a pinch of salt would you take when it comes to the 25 dots? The Fed's, all of our predicting capabilities have been severely tested this year.
I think you take a very big pinch of salt with anything relating to 2025 predictions. The data has confounded many people. The cycle has not evolved the way we would have thought.
Yeah.
It's a very different cycle than what we're used to. And I think the market recognizes that if we're talking about the 25 dot, for example, it's so data dependent. There's so much evolution that can happen to that prediction over time that it's weighted certainly less, I think, than it would have been in the past.
In terms of, so how are you thinking about the kind of the way that the arithmetic works? If we get 2 this year, do I assume that I'm getting a cycle, or is this just a mid-cycle kind of adjustment? Do I assume that I'm going into a full-blown kind of cutting cycle here, and there are going to be more that follow? It's interesting. This is the debate that we're having at the ECB right now, and I'm just, what is your kind of current thinking about how many we get in total? Is it a cycle? Yeah. What makes a cycle?
Yeah. Well, the ECB made sure to stress that it wasn't the beginning of an easing cycle. They clearly want to retain optionality, and I think that's going to be the major theme out of central banks, is that we will adjust, we will respond to the data, but we want to maintain optionality. We don't want the market to get ahead of us. We don't want the market to maybe ease financial conditions in a way that's not really beneficial. So I suspect that we're never say never, but it's going to be difficult to get back to the zero lower bound. I don't think that's where we end up this cycle. I think we're talking about a cycle that ultimately looks like 200 basis points worth of easing, and probably a bit more spread out than what we've been used to over the last 10 or 15 years.
A final question to you on the reason you're in town, of course, and that is that expansion into Europe. One of the things I've noticed in this part of the world during my time here is that there is a delay in terms of cross-border transactions. Things aren't cleared as quickly as they are in the American markets. How long before some of those cross-border transactions that even politicians across Europe are trying to make work faster gets to the level that Citadel has created in the States?
Yeah, and I think that's a good point that you raise, and one of the main impetuses for us getting into this market is obviously providing liquidity to our clients, improving their day-to-day experience, but also where we can to push market efficiency and to push the market in a way that's beneficial for all those involved. So that's what we're focused on, and that's what we're focused on delivering.
Do you have a timeline for that?
No timeline. I think head down, get to work, and see where we end up.
All right. Well, we will, of course, love to have you back and get that update on how that's going. Michael DePaz, a pleasure to have you on the program. Global Head of Rates Trading at Citadel Securities, Guy.
That's a good attitude. Okay, coming up, UK unemployment hitting its highest since 2021. Muted reaction in the pound. Some softening, but we are way away from the kind of levels you need to see, particularly on wages that are consistent with a 2% inflation target. We'll talk more about this next. This is Bloomberg.
What do you consider to be the biggest challenge?
Infrastructure that supports trade is the biggest challenge. Our senior brother, President Adesina of the AFDB, estimates the annual deficit, infrastructure deficit in Africa to be over $100 billion. But that over $100 billion is actually also an opportunity for investment. So it is a massive, significant challenge that we are confronting. And my fear is that we may succeed in establishing a very effective legal construct and a very effective legal foundation for trade liberalization and investment liberalization in Africa. But all of that will come to naught if the infrastructure deficit is not addressed, because you will need the goods to move somehow, and you will need to have good trade corridor connectivity, ports, trade corridors that connect countries that are landlocked to the ports.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg. Welcome back. This is Markets Today, 8:45 here in London. We are 45 minutes into a European trading day that rebounds a little from yesterday. Certainly in the Paris market, we're up by 0.4%. And that is now, after a slow start, outperforming the rest of the European story. But the rest of the European story is sluggish, up 0.1% only on Stock 600. US futures more muted as we wait for plenty of data out of the US and an FOMC decision. We've had data out of the UK already this morning. UK unemployment unexpectedly rose to the highest since 2021. That's while private sector wage growth cooled to the lowest in 2 years. The figures show the labour market is slowing down, but it is unlikely to be enough to persuade the Bank of England to begin cutting interest rates at next week's meeting. Of course, the politics might play in there as well. Let's talk to Sandra Horsfield, senior economist at Investec, who's with us now. Sandra, on first glance, it seemed possible to draw sort of mixed conclusions from the labour market data out this morning. But, you know, diving deeper, maybe there are reasons for the Bank of England to feel reassured and that we're getting closer to the point where they can cut interest rates, but maybe the politics gets in the way. Your initial response to the data we had out this morning?
It's certainly heading in the right direction. Yes, there are more...
Oh, sorry, I missed that. You said they're heading in the right direction. Oh, okay.
She doesn't look like she's moving.
No, she doesn't, does she? Okay,
we're going to get her back.
Sandra Horsfield.
It
there
says
you go.
so on the screen, yes. Apologies to Sandra if you can hear us. We can't hear you. Your picture froze, so we're just going to try and reinstate that picture. But you made the point going to break, Guy, about where we are on the inflation story, where we are on the wages story. In fact, that the wages, they're too high to give us 2% inflation. Is that the conclusion we got from Dan Hansen?
You are at kind of circa 6% right now. You need to be at circa 3% in order to make the 2% inflation target. We are miles away from that, but the trend broadly appears to be in the right direction. The unemployment data, broadly the inflation data, I think here sorry, the labour market data here is something that I think the market does need to be slightly sceptical of as well. The return rate we're getting in terms of the data, the surveys that are being done to get this data are relatively poor at the moment. And the labour market data continues to be really difficult to, I think, interpret here in the UK, which is why maybe actually the Bank of England has placed a much greater emphasis on what it's seeing in the service side of the economy. So the service sector data is really where we appear to have kind of put most of our attention, certainly from a Bank of England point of view.
Let's try that again, shall we? Sandra Horsfield, senior economist at Investec, I think joins us now. And let's hope this time it works. Signs aren't good. No,
I think we're not going to do this again until we definitely guarantee that this is going to work. So let's carry on with the conversation.
It's been a good 1 hour and 48 minutes of the show anyway.
We were pressing our luck.
gone to pot. But yeah, think about where the Bank of England goes from here, then pretty. And of course, the politics has got in the way. They put themselves into a sort of self-imposed purdah. So we haven't heard very much from the Bank of England and what they're thinking about any of this data. And we're not going to, because of course, even in the wake of, we are going to get a rate decision, but then we don't get the election until July 4th.
Yeah, and you know what I thought was super interesting? Anna Andrade of Bloomberg Economics talks time and time again, I think every time she covers any economic data point, is that the BOE is far more reactive than some of its other central banking peers around the world. But you're not actually seeing that show up in the markets, for example. I think this is the biggest slide I've seen on a UK data point that's actually stuck when you look at cable. 127.19 right now on that currency pair. It kind of feels like the sensitivity is kicking in, but I'm curious how that changes going into the CPI next week.
Yep. I think the sensitivity, to Anna's point, it's really difficult to judge kind of how sensitive the Bank of England is right now. Because also there are different views on the MPC, which you are getting those different views manifesting themselves in a way that we're not seeing on other central banks. I think the Bank of England is really hard to call. Is it August? Is it September? Kind of how does the data evolve between now and then? How does the politics evolve between now and then? We're also not going to get a fiscal event probably for quite some time, so that's going to be something else that we need to factor in as well. But it does seem as if the clearest kind of narrative for the UK economy is around services, and that's where they make their kind of make their sort of bed. Let's kind of think also about the fact that the ECB has gone and is now having to, in some ways, be a little bit more cautious, having made that initial rate decision. Yeah. Which I think is a kind of, maybe it's a lesson that the Bank of England is watching quite carefully too.
Yes, I think it's really interesting, the commentary we had out of Christine Lagarde just over the last 24 hours. I mean, it is interesting what she said, but also how widely she said it. So this is an interview that she's given to one European newspaper that seems to have been picked up and published in lots of different European newspapers. This message going far and wide. It's not necessarily the case that they're on a declining linear path and they may need to hold again. And this goes back to that. Yeah, how many rate cuts do we get from the ECB? Is it? I mean, it's, you know, the ECB won't want to think it's one and done necessarily. And we talked at the top of the program about what a policy mistake looks like. But there isn't the assumption that we've seen in times of crisis that you get cut after cut after cut, month after month. Yep. On that kind of cadence.
So you've tried twice. I'm going to have a go now.
Excellent. Okay. I'll leave it to you, Guy.
Maybe I'll have slightly better luck.
Third time's
Sandra Horsfield, can you hear us? That's where I'm going to start. I think that's my first question.
I can indeed.
Excellent.
I can.
Excellent. This is good. We're going to start there. First question, tick in the box. Second question: is today's data consistent with a August rate cut from the Bank of England, a September rate cut from the Bank of England? How does today's data feed into the argument about the timing surrounding that central bank decision?
We think we'll still get there by the time August comes along. What we're seeing is more signs of weakening in the activity metrics of the labour market. In time, you would think this translates itself into weaker wage demands as well. Vacancies are still falling. We are at the highest level in unemployment in 2 years. All of these factors should play a role. It's just not there yet, not enough to really prompt a rate cut just as soon as this month.
In terms of how you are thinking about which data the bank is focusing on, how important is the labour market data? How important is the wage data vis-a-vis certainly what we're seeing with services? How should I weight the relative importance of the data?
We think the wage numbers really are crucial, and that is because wages are, of course, a very important input into price pressures, and that's the part where you think what the Bank of England does in terms of its policy rates will have the most direct impact. So what we're seeing now, specifically, it's not the overall wages that matters the most, but the private sector regular pay series is the one that the Bank of England focuses on. And we are seeing progress there. Yes, we did see a decrease in the annual rate there. 5.8% is not yet good enough, for sure, though, if you consider the soft picture that the UK is producing in terms of productivity. We can't afford 5.8% pay growth with the poor productivity growth on a sustained basis. But wage growth is slowing, so perhaps soon we will be in a position to cut rates.
Okay, so those kind of wages not sustainable, you think, with that kind of productivity level. What difference does the politics make, Sandra? We are waiting for details, I suppose, from various parties, but the market orthodoxy at this point seems to be that the market isn't too worried about the UK election in the context of other bigger global worries that it might have, other political events markets might be more worried about. What difference will the election make to your thinking around the UK economy?
Well, in this particular instance, for the next meeting, the politics makes a very big difference in that the Bank of England is in a self-imposed purdah period. It's not officially bound by the same rules as other civil servants are, but it is choosing not to speak around the time of the election itself. So to surprise the market with a rate cut right now and not be able to explain it, that seems very unlikely. So we think the chances of an actual rate cut this time around is very slim because of the timing of the election. Now, what happens afterwards? I think if you look at the sort of basic policy premises that are being put out by the Labour Party, but also by the Conservatives, the differences are not actually all that large. We are still very much scarred by the Truss experience and by having to pursue a very tight fiscal backdrop and navigate that without major changes. So all of these factors will play in, but I think the market is quite relaxed because huge unexpected fiscal policy shifts are unlikely whoever ends up taking power.
Sandra, forgive me, this might be a fairly simple question, but what is the bar for the rate hike narrative to seep back into the picture? Just 2 months ago, it felt like really markets on both sides of the Atlantic were considering the possibility of a re-acceleration of inflation narrative. What is that still on the table? What does it take to get there?
I think if we think of what central banks are trying to achieve, there are certainly parts of inflation that are completely outside of their control. Energy prices, obviously the global economic backdrop is very much influenced by factors such as these. But there are parts that they can affect, and the important part they're trying to affect are inflation expectations. And if you look at those, there has been signs of progress. It has been very encouraging that the high inflation episode hasn't really destabilized inflation expectations on a very sustained basis. We're seeing declines in inflation expectations. That means central banks can, in a forward-looking sense, reduce their policy rates, not because the economy is falling off a cliff, but because if we have low inflation expectations, simply keeping rates where they are would make policy more and more restrictive. And that becomes unnecessary when inflation is heading lower. So we're in a very fortunate position of being able to lower interest rates to respond to an easing in inflation expectations. And that's the Goldilocks path that we had all been seeking. Now, exactly how quickly we get there, that is a different matter.
Yep.
And that's perhaps
Sandra,
not quite evident.
Sandra, great stuff. Thank you very much indeed for bearing with us. We greatly appreciate it. Sandra Horsfield, Senior Economist at Investec. Thank you very much indeed. Quick run through what we're expecting for the rest of the day. There's an auction, there's a Ukraine recovery meeting, which we want to keep an eye on. OPEC monthly oil report. Oracle earnings are out a little bit later on. A bunch of ECB policymakers are going to be speaking as well. But I think what we're really waiting for is CPI out of the United States tomorrow. And the Fed meeting.
Yeah, just the small matter of the Fed meeting and the US CPI. Yep. It feels like the whole month's been condensed into a day.
The cool kids are calling it a double whammy.
Is that what the cool kids are calling it?
The cool kids are. You clearly did it. I'm informing.
So glad
informing the crew.
What the cool kids say.
Just letting you all know. We'll see how that shows up. That does it for markets today. The Pulse is up next. This is Bloomberg.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Was going to keep Green World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. And market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. Apple unveils new AI features, including the partnership with ChatGPT. Elon Musk responds by threatening to ban Apple devices from his companies over security fears. More record highs on Wall Street as traders position ahead of U.S. inflation data, and of course, the Fed decision. Plus, UK unemployment rises unexpectedly to the highest in more than 2.5 years, while pressure eases for higher private sector pay, suggesting inflationary forces are cooling. There's a lot going on, so good morning, and let's take a look at the European markets map. Now, we're still trying to figure out exactly what the calling of the election in France means for the CAC 40 and some of the businesses. Yesterday, we saw quite a lot of, I guess, anxiety, not only in bonds, but also in equities. Today, we're seeing a little bit of a lift. Now, there's more calm, certainly, than there was yesterday, and this is after a pretty hectic day yesterday with heightened political risks really trying to reverberate across asset classes. The focus now firmly on two things tomorrow: U.S. inflation data and the Fed's interest rate decision. Wednesday is going to be a very, very big day. There is also a French bank, Société Générale, extending some of the losses after Reuters reported that the lender's struggling to reach a deal to sell its securities services unit. Euro dollar 107.61. You can see S&P futures practically unchanged. And then for good measure, let's always look at the U.S. at 10-year yield 4.4453. So onto Apple, and it's unveiled its long-awaited suite of new AI features, including a partnership with OpenAI, the maker of ChatGPT. Now, the iPhone maker is betting that a personalized and understated approach to the technology will win over customers. It's a high-stakes bid to catch up with rivals in the booming AI market.
Recent developments in generative intelligence and large language models offer powerful capabilities that provide the opportunity to take the experience of using Apple products to new heights. Introducing Apple Intelligence, the new personal intelligence system that makes your most personal products even more useful and delightful.
Well, let's get more on the story with Matt Bloxham from Bloomberg Intelligence. Matt, you were here yesterday. We were talking about what we could expect from this event. And now they're trying to make AI, I guess, work for everyone. They're trying to retake the spotlight. I mean, have they done enough? Is it exciting enough?
I mean, it is exciting, but I think all of they said yesterday had been very well flagged, so there was nothing incremental that nobody was expecting. You know, this is a very broad range of updates across all the familiar apps that you would use if you're an Apple user, so messaging, email, Safari web browser, notes, the whole suite, and these are going to be kind of meaningful enhancements to how those products work, you know, offering you prompts, allowing you to kind of rewrite an email reply to somebody, for example. So lots of familiar generative AI features all embedded into those applications. So I think it's a bit like a few years ago where it was like, are people going to upgrade to the first 5G iPhone? This is the first AI iPhone, and so are we going to see this kind of super cycle that everybody's talking about in terms of smartphone upgrades? Yeah. That's still a big question. I think clearly it's going to prompt a lot of people to upgrade to a new iPhone because people have been stretching out how long they keep their phones. And this is a significant new feature that you can only get if you've either got an iPhone 15 Pro or Pro Max, or you buy one of the new devices. So it's not going to be backward compatible for the vast majority of the iPhone user base. So people think, well, I want generative AI, I need to get a new phone.
So Matt, you can basically, upload it on some of the current models that you have, or otherwise you need to wait for the new ones in September?
The only models currently that will work on is the 15 Pro and the 15 Pro Max, which is the very top end of the current range. All of the other iPhones out there won't support the AI functionality.
Elon Musk was pretty punchy.
Yes, he was.
He was really
never misses an opportunity.
What do you make of his threat?
Yeah, well, I think there's a lot here. You know, he's got an ongoing feud with OpenAI. He's got his own rival to OpenAI under development. It was an opportunity to kind of make some noise about his views on AI. He's obviously been quite an outspoken critic of the risks of AI generally. I think there are some legitimate concerns he raises about privacy issues around how we're using generative AI products and the fact that these platforms can potentially suck your data unwittingly and use it against you without your permission. Clearly, Apple's gone out of its way to protect user privacy in everything it's doing here. So I think, you know, whether the integration of ChatGPT into iOS 18 is really what Elon Musk talking about is unclear, but you know, it clearly allows him to kind of have some relevancy within what's clearly the topic of the day, if you like.
I like it. The topic du jour, Matt. As always, thank you so much, Matt Bloxham there from Bloomberg Intelligence. Now, let's talk to Sharon Bell, Senior Strategist at Goldman Sachs. Sharon, thank you so much for joining us. So we have you for 20 minutes to try and figure out what is going on in the world. I mean, when you start with AI and on the back of some of the technology that we see in Europe, is AI still going to be the main driver for American markets, and what does it mean for Europe?
I mean, obviously AI has been such a crucial driver, but it's not been the only driver. And I would say you take Europe year to date, the bank sector has been the best performer by far, and that's definitely not AI driven. So I do think it's broader than that. But obviously people love this thematic because it means it's going to be a big driver of growth. We see Apple developing new products, other companies developing new products, etc. So it's going to be a huge driver of growth. I have no doubt about that. But it's not the only area. And I think, information like politics, activity improving, all of those things create much more market volatility than just AI.
Yesterday we saw, markets really taking badly the fact that Emmanuel Macron called for elections in France. I mean, there were questions about whether this delays, having a new Commission president, what it means for green policies, what it means also for the capital markets union. Where do you think the most, significant fault line is?
I think the problem is it does increase uncertainty, doesn't it? I mean, it doesn't forever, of course, because there are election date, but it does increase uncertainty at a time when European markets, global markets, but Europe as well, has done quite well in the last 4 or 5 months. So you've had quite strong markets, you've had an interest from global investors with some nice positive inflows into Europe in recent weeks, and now we've got this big uplift in uncertainty, and I think that's what markets really haven't liked.
So what's the catalyst for markets going forward?
Well, I think there's a few key things, isn't there? One of them is what happens to interest rates. Now, we've seen the ECB cut, but quite a hawkish cut, let's say. So confidence in the direction of interest rates is obviously super important. That they do still come down on a sort of maybe quarterly path from here, giving the market a bit more confidence, that's key. And the other thing is just purely activity. In fact, I would argue activity, although I put it second, is actually the primary driver of global markets. And we've had rates stay a little bit higher for longer this year, but equities have done well, and they've done well because of better activity growth. So I think still getting the good data coming through is really important as well.
When's the next ECB cut? How difficult is it? Because you're right, it was a hawkish cut, and actually a lot of the governors are also saying, let's wait and see. There could be an uptick. Like, we're not sure how inflation pans out.
No, and nobody is, are they? And central bankers, economists, academics have had it wrong, really, in the last few years. Inflation proved to be much more sticky initially, then it came down, and now it's proved a bit more sticky again. So there's a lot of uncertainty around it, but we do think they'll do 2 more cuts this year. They're cut at a quarterly pace, so September and December is most likely. And then we do think a few more cuts into 2025 as well. And Lagarde clearly pointed, even though she wants to make it clear that this isn't necessarily going to start of a whole string of cuts immediately, she did make it clear the direction is likely downwards from here.
Do you worry about, this was the topic of 4 or 5 months ago, is actually if rates stay at these kind of levels, we're going to see damages in the economy. I don't know whether the employment figure in the UK is part of that, because that's largely been dismissed in the markets.
Yeah, look, I actually think that rates at this level has quashed demand a bit in Europe and the UK. I mean, to your point on unemployment starting to rise in the UK, manufacturing in Germany has been in the doldrums, really. No growth at all for the last couple of years. So absolutely, I do think there's a lot of evidence that higher rates in Europe have quashed activity. But they've needed to quash activity to bring down inflation. But if you do feel that inflation is on a downward path for lots of reasons, then you can start releasing some of the quashing of activity that we've had.
So where do you see value? Is there anything that looks particularly attractive right now?
Oh, look, this is a great question, a really, really good question, because if you'd asked me 8-9 months ago, I'd have, slammed the table. Europe was, in fact, very, very good value at the time, below average valuations on every single measure you should look at. Now it's more like average, maybe even slightly above, sort of 20 or 30-year average PEs, etc. So it's not super, super cheap anymore. And of course, there's risk and uncertainty. We've just been discussing the French elections. But I do think there are certain sectors, banks and energy, for example, are 2 sectors which still trade on dividend yields of 5, 6, 7%, which is incredibly high. They are often still buying back shares. They've still got a bit of growth. They're linked into global activity being okay as interest rates come down. So actually, I do feel there are pockets of value. And of course, things like tech, it's not value for sure, but it's got the growth that we talked about before.
But Sharon, do you think companies will have to work that much harder with dividends and share buybacks to keep investors happy if they're based in Europe?
I think companies absolutely have been working hard in the last couple of years. I mean, dividends, the funny thing is we haven't had much economic growth, but we have had pretty good earnings growth, actually. Companies have liked a bit of inflation. And what they've done is they've paid investors back with dividends and buybacks increasingly. European companies never did buybacks. I used to spend all my time explaining to US investors why European companies just didn't do this. They couldn't understand it. But now, all of a sudden, European companies are doing buybacks. They're giving back investors both dividends and they're buying back shares. In fact, if you take, say, the energy sector or the bank sector, they're giving you back as a shareholder 10% of your market cap through dividends and buybacks. And this is a complete transformation for these companies. So I would argue, yes, they will need to, and yes, they're already doing it.
Sharon, thank you so much. Sharon Bell, Senior Strategist at Goldman Sachs, stays with us. We'll have plenty more, of course, on the rest of the world, but also the UK. Coming up, we're going to bring you a deep dive into Hong Kong's property slump. That's next, and this is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Now, Hong Kong's deepening property slump is about to reach its 5-year mark, the longest retreat since the depths of the SARS crisis more than 2 decades ago. Well, Bloomberg Intelligence estimates at least $270 billion has been erased from real estate values in the city since 2019. Well, our Asia investing editor, Russell Ward, joins us with the very latest. Russell, thank you for being here. Now, what makes the current property slump a little bit different to some of the earlier downturns?
Hi, Francine. Yeah, I mean, it's no secret that Hong Kong has had property slumps over the years. But, you know, it's always bounced back. It's been regarded as being unsinkable. But this time it's different. There are questions actually whether it will bounce back. And that's really mainly because of the diminished status of the city as a financial hub. You know, it's no secret that President Xi Jinping's, security law that he's introduced, the COVID restrictions that were bungled. We've had an exodus of foreigners and also locals as well. The population has been declining, and so really there's been a lot of pressure on the property market because of those outflows, and really looking forward to the outlook for the city, it's not looking bright. We just had some news this week about questions over the rule of law in Hong Kong, with some foreign judges leaving the city. So that's not really good for the city as a status for its status as a leading financial hub, and that's really adding to the downturn in sentiment in the property market, both on the housing side and also in the commercial property sector as well.
So, Russell, why has policymakers not done more? Again, we were waiting for a big bazooka or something. I know that the government tried to, for example, scrap stamp duties earlier this year, but has it had the effect they wanted?
Yeah, I mean, there was a short-term boost in sales anyway. So what they did was in March, they scrapped extra property taxes, and so that actually led to a bit of a frenzy in sales. But the key thing with that was that these sales of new home units were being sold at a discount. So these property tycoons, the famous property companies like CK Asset and Henderson Land, were selling these brand new projects. People were flocking to them, but unfortunately they were being sold at a lower price. So we're still seeing this funk in prices, and in effect the sales have also been coming off in the past few weeks as well.
Russell, thank you so much. Our Bloomberg Asia investing editor, Russell Ward. Now let's go back to Sharon Bell, senior strategist at Goldman Sachs. Sharon, I want to ask you about property and maybe some of that space in Europe, but also the effect of the China rebound, which is there or not really there. We're uncertain what kind of path they go towards, especially in a U.S. election bashing China year. Yeah, and what that means for Europe.
Yeah, look, Europe does have quite a lot of exposure to China, both indirectly and directly. Maybe about 10% of European company sales are direct to China. So it is quite important. Not only that, as you say, if Trump were to put more tariffs on China or Asia in general, then you will likely see more goods from China come into Europe and compete with European producers. So yes, I do think there's quite a lot of competition there.
Is there a way, I mean, how do European companies, is there something that they can do to fight back?
Well, I mean, they would argue that they've moved into China in the last couple of decades because it offers more growth than Europe. Yeah. So I think the exposure to China per se is not necessarily a bad thing. And of course, if China's moving up the value chain, importing more into Europe, Europe can also innovate and improve, and in that sense, fight back against China. Another way, of course, is European companies moving their businesses to other growth places. For example, with a group of companies in Europe which are exposed to India, which is growing fast. So, there are lots of different ways that European companies can diversify, let's say.
And Sharon, what do you do with real estate? Again, this has been one of the hot topics for the last 6-7 months. Is it something that you just wait and see what happens?
I think we're probably in that camp. We'd be neutral on real estate in Europe. It's a tricky one because valuations are really low now. So they definitely, you asked me before what value pockets there are in Europe. Real estate is almost certainly one of those. But what you really need to see is, again, more confidence in the path of interest rates. And we did have a cut from the ECB, but it was quite a hawkish one. So I think you don't have that confidence yet.
So if you look at almost country by country, or Southern Europe compared to Northern Europe, do you also have a bias of actually Southern Europe looks more attractive?
Well, I mean, not necessarily on property, but if I think about Southern Europe, there are some attractions to it at the moment. It's got more of the recovery fund monies to spend over the next couple of years, which has been great. Growth has been a little bit better in Southern Europe, particularly in Spain. So I think, and Southern Europe, again, hasn't been in such a weak manufacturing position as, say, Germany. So I do feel Southern Europe. And the other thing, I guess, is we haven't seen sovereign spreads widen out. Did a little bit yesterday, but generally we haven't seen the sovereign spreads widen out, so people don't put a big risk premium on Southern Europe at the moment. So yes, probably slightly more attractive.
And this is all Southern countries. I mean, some of them put more structural reforms than others. Do you make a difference, or is it more of a block?
Yeah, I mean, you've seen, Greece has really changed in the last couple of years, which is fantastic. Spain has seen fantastic growth. I mean, it's the one place, if you looked at the GDP numbers of Spain, you'd think you were looking at the US in terms of the pace of growth. Very, very different from the rest of Europe. So I would say Southern Europe's in a better position generally. I guess we would still worry structurally about Italy. Yeah. Its debt level is very, very high, for one thing. Its demographics aren't as good either.
Sharon, thank you so much. Sharon Bell, Senior Strategist at Goldman Sachs, stays with us. We'll talk UK next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Welcome back, everyone. UK employment actually rising again. This was pretty much unexpected because that's the highest in more than 2.5 years. Pay pressures are easing, and that keeps the Bank of England on track to cut interest rates later this year or possibly sooner. So here to talk about the UK, let's get straight to Sharon Bell, Senior Strategist at Goldman Sachs. Sharon, thank you so much for sticking around with me. When you look at UK, the employment figures were a bit of a wow moment, right? Because they rose more than expected at a time where we're not hearing from the Bank of England at all because the election is July 4th, and we're also going through the manifestos.
Absolutely. And, actually unemployment, this one figure, as you say, was a bit of a surprise, but the last few figures have shown unemployment ticking up more than expected. So I think this is part of a series of figures that show this higher unemployment. And of course, the good news for the bank, though, and the economy, I would argue, is that wage inflation is starting to slow a little bit. And that does give them the room, ultimately, to cut rates.
Do you think that they could be already a little bit behind the curve? I know they were, they were probably behind the curve in raising rates. Is there a risk that they do the same on the way down?
This is the problem, and this is always the problem of being data dependent, because you're data dependent for the data today, and not necessarily the data in 6 months' time, which is really when interest rates are going to affect things. But I don't think they would regard themselves as behind the curve. Yes, unemployment's ticked up, but it's still relatively low versus, say, the last 30 years. We're not at a high level. And yes, wage inflation is coming down, but it's still relatively high. So I think they probably regard themselves as right to be cautious.
I mean, today we're also looking at manifestos from both parties. Is it quite incredible that there's not that much market reaction yet? Because they're quite similar, or what do markets make of it?
Well, I think that there's probably two reasons why there wouldn't be much market reaction. First of all, given the polling data puts the Labour in so much of the lead, it doesn't feel that there is, that outcome feels very priced, I would say, by the market, given that lead in the polling data. One reason. The other reason is there's not a lot of difference in their ultimate fiscal policy. Yes, there are a few different tax rinky-dinks they can do, each party, but ultimately they are both under the same fiscal constraints.
So are you, attracted to UK assets, or there needs to be more growth and risk-taking?
Yeah, I think I quite like FTSE 250, which is your classic quintessential UK asset in many ways, because FTSE 100 is a global asset. I don't dislike that. It's got lots of those banks and energy stocks I was talking about before, which are buying back shares and doing dividends. But the 250, the mid-cap stocks, it trades at a relatively low valuation versus its history. It is in that cheap camp, that bucket. And I do think UK economic activity will be okay, even with this tick-up in unemployment. And I think as rates come down, that will support those stocks as well.
Okay, so interesting. Sharon, thank you so much for being with us today. That was Sharon Bell, a senior strategist at Goldman Sachs. Now, coming up, the UN adopts a U.S.-crafted truce deal. Secretary of State Antony Blinken arrives in Israel. We'll have plenty more on the ongoing ceasefire talks. Next, we also have our D.C. bureau chief, who's in London for a couple of days before she travels on to G7. So I'm looking forward to hearing from the election campaign there in the U.S. and what happens in November. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
It's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Well, Apple unveils new AI features, including a partnership with ChatGPT. Elon Musk responds by threatening to ban Apple devices from his companies over security fears. More record highs on Wall Street as traders position ahead of the U.S. inflation data and the Fed decision. Tomorrow's a big day. Plus, UK unemployment rises unexpectedly to the highest in more than 2.5 years, while pressure eases for higher private sector pay, suggesting that inflationary forces are cooling. Well, good morning, everyone, and welcome to The Pulse. Happy Tuesday. I'm Francine Lacqua here in London. A couple of things we need to watch out for is, for example, Olaf Scholz and President Zelensky focusing today on a European recovery effort. The focus of today, and you can see actually Chancellor Scholz live from Berlin, actually the focus is on the battered energy infrastructure in Ukraine. So this conference is bringing together government officials and company executives and really follows some pretty similar meetings, I believe, in 2022 in Italy and then London last year's. Now, let's get to the U.S. elections. And jurors in Delaware are deliberating if President Joe Biden's son, Hunter, is guilty of illegally buying and possessing a gun while on drugs. Now, Biden's defense argued that he did not knowingly violate the law because he may have thought that he was clean at the time he purchased the weapon. It comes less than 2 weeks after his father's chief rival for the presidency, Donald Trump, was found guilty by a New York jury of 34 counts of falsifying business records late last month. Now, for more, we're joined by Bloomberg's D.C. bureau chief, Peggy Collins. Peggy, this is such a treat to have you in London. I know then you're making your way to the G7, but you say the election campaign has started in a new phase. Why do you say this?
Well, I think it's for two reasons, Francine. One is the fact that while Trump was going through the trial for weeks in New York, he had to actually be in the courtroom at least 3 days a week. So he was constricted in terms of how much he could campaign around the country. And we saw this weekend that as soon as the trial wrapped and he was convicted, he was out on the campaign trail again to Las Vegas, Nevada, one of the most competitive states that we have in this election. The other reason is cash. So one of the things that Biden has had an advantage on for most of this year is campaign fundraising and cash. At one point, he was more than double in terms of Trump, in terms of cash haul, over $100 million raised. But Trump, after the days of the trial verdict, raised $50 million and has continued to raise some cash over the past week or so. So that gap is closing in terms of an advantage between Trump and Biden.
So, Peggy, is this Wall Street cash? Is this big donors like Steve Schwarzman that, finally put his weight behind Donald Trump? Or is this, mom and pops kind of believing in Donald Trump as a candidate?
It's both. They've been able to raise quickly from grassroots donors online. And then, as you said, Francine, we've seen some very big donors start to turn towards Trump in just the last few weeks, including on Wall Street.
So do the voters care about these trials?
They do. They do. One of the things that we've been reporting after Trump's conviction is that it could have an effect on that very slim number of people who are really independents in the middle in terms of they haven't decided yet. There are obviously a lot of independent voters in the states, but there are many voters who have already decided on one side or the other, and the conviction for Trump could have an effect on those voters. And on the Hunter Biden trial, we are expecting that a verdict could come as soon as today. The jury is deliberating, as you said. That obviously isn't President Biden himself, but it certainly is in the media and has been a touch point for some of Trump's base.
So for Donald Trump, is there, for example, females between a certain age group that are more likely not to vote for him because of the trial, or is it impossible to break down?
I think it's difficult to break down, but I will say that the women vote for Trump has been one of the big question marks of this entire election year. That is in part because of reproductive rights and abortion rulings, and because in some of the most competitive states, like Florida, like Arizona, like Nevada, there's the potential for a ballot measure to be on Election Day related to abortion, and some of the Democrats feel like that may actually increase turnout, particularly among women, and hurt Trump potentially.
Peggy, if the vote were tomorrow, who would win?
Well, I don't know, again, because we're not in the minds of every American voter. But in terms of our polling, we've had a swing state poll since last year at Bloomberg. And what it's continually showed is that the race is, one, very close in the 7 most competitive states, but that Trump is leading in most of the swing states as of today, as of our latest polling in May.
So Nebraska, I mean, I've had French viewers saying, Nebraska? Where is Nebraska? I mean, Nebraska could be actually a very, very important state.
It's really interesting, Francine. So we were just talking about those swing states, and the Biden campaign has been looking very closely at northern states, what we call the blue wall. That's Wisconsin, Michigan, Pennsylvania. And because of changes in population, one city in Nebraska called Omaha, where Warren Buffett is from, could actually come into play because that one electoral vote in Nebraska could be pivotal in this election.
I mean, is it mainly, what kind of demographics does Omaha have? They're not all Warren Buffetts.
That's right. That's right. Well, some of the Midwestern states like Iowa and Nebraska do tend to be older in population, but a lot more young people have stayed there over the years with work from home and cost of living. And also it does tend to be a more liberal city, Omaha, because of the way it's changed over the years.
So I'm going to take advantage just because you're here. And we keep on, hearing of people saying, look, Donald Trump and his team are just very good at campaigning. They did it the first time around. They hit the right spots. He's tireless. How's the Biden camp doing?
Well, I think they're both working around the clock at this point because we only have a few months to go. I know here in Britain you only have a few weeks to go, but in the U.S. we only have about 5 months to go. So it really is reaching a crescendo phase here now. But we are expecting the first debate between Trump and Biden to be in just a couple of weeks at the end of June. So they are prepping for that, and that will be a pivotal moment.
I mean, it's just incredible. You're right in terms of the length of time, but also the amount of money. The U.S. election campaign is just incredible compared to Europe. Peggy, thank you so much for joining us. Bloomberg's D.C. Bureau Chief Peggy Collins here in London and then traveling to the G7. Now, U.S. Secretary of State Antony Blinken says the Israeli Prime Minister Benjamin Netanyahu has reaffirmed his commitment to a U.S. ceasefire plan. Let's bring in Jumana Bersace, our Horizons Middle East and Africa anchor. Jumana, great to speak to you. I mean, Secretary Blinken is on his 8th visit to the region since October 7th. Are there any hope for a way forward to a ceasefire?
That indeed is the question, Fran. Good morning to you. So Secretary of State Antony Blinken is making his 8th trip to the region since October 7. He was in Egypt yesterday meeting with President Sisi, gave a little talk to reporters afterwards saying that Hamas were the main obstacle to getting the ceasefire deal over the line. He then continued with his trip on to Israel, meeting with Israeli Prime Minister Netanyahu alongside Defense Minister, in addition to Benny Gantz, of course, who was the key government member who quit Netanyahu's government over the weekend. So meeting with a broad range of voices over there. He just delivered a press conference in Tel Aviv saying that the Prime Minister Netanyahu had reaffirmed his commitment to this Biden truce proposal. And so what we're hearing now is there has been some progress made on at least this phase 1 of the proposal. Phase 1, as a reminder, would include the exchange of some hostages, the release of elderly women and children who have been held in Gaza territories in exchange for some Palestinian prisoners, in addition to a 6-week ceasefire. But the big question remains as to what is going to happen in phase 2. And this is where there's still a lot of daylight, because phase 2 would entail a permanent ceasefire. Israel are saying that they're not going to commit to a permanent ceasefire until all hostages are released. Hamas are saying that they're not going to agree to a permanent ceasefire unless Israel provides some solid commitments that they will not continue with a ground offensive. So still some daylight, but a little bit of progress has been made in this trip.
So, Jumana, the UN Security Council also passed this resolution endorsing the ceasefire plan from the U.S. Again, how will this play out?
So that was a big development yesterday, Fran. 14 members of the Security Council voted in favor of the resolution put forward by the U.S. Russia did abstain, which is notable in itself because now you are getting sort of a worldwide movement in support of this Biden three-point plan. It should be said, however, that since October 7, the UN have really taken a bit of a backseat. It was only until a couple of months ago that the US themselves were shooting down these ceasefire proposals. And so it's unlikely to have that much of an impact. However, it does tell you that the US have been successful to a certain degree at mobilizing support from around the world. And if indeed Biden does succeed at getting this deal across the line, it could be construed as a political win for Biden himself into those elections that you were just talking about.
Jumana, thank you so much. Bloomberg's Jumana Brzecia there in Dubai. Now, the Ukrainian President Volodymyr Zelensky is also, as we're seeing live pictures, addressing a two-day international conference on the reconstruction of Ukraine in Berlin. Now, the German Chancellor Olaf Scholz and the European Commission President Ursula von der Leyen are both in attendance. Governments, executives, and investors are really already preparing for a reconstruction program in Ukraine that the European Investment Bank estimates could amount to more than $1 trillion of public and private capital. Now, this is the front-facing. When you speak to a lot of investors on background, they say it might be a little bit too early, given all of the questions and the concerns on the ground in Ukraine. Let's listen to the president of Ukraine.
Engaged in the effort to withstand the attempt to drive a wedge between the countries of the democratic world. We are fighting for humanity in the world, to allow the people in the country to continue to live a normal life, to show endurance, to prevail, to win the war. That is the kind of resistance we've shown. Resistance in all areas, in the military area, in protecting the country, in showing resistance also as members of civil society in the face of the battle and the war that is being waged. To continue to pursue a European lifestyle, a lifestyle that is being demolished and destroyed wherever Putin is active, wherever Russia places its foot. It begins with the division and hybrid warfare, as has been the case in Moldova and Georgia, and later we witness a total war like the war against Ukraine. The front plays an important part. In 2 years of war, Ukrainians have proven that they are able to withstand the attacker and to advance in that area. We can force them to withdraw. We have regained the Black Sea. And we have furnished proof, thanks to the modern air defense system, that we are capable of bringing down Russian missiles. Now, what is important? Key abilities in order to be able to place Russia at a disadvantage and rob them of the strategic advantages that it has had. Advantage with regard to the airspace is therefore important, defending us from missiles and attacks via the air.
Of course, we'll continue covering this conference in Berlin. Coming up, we take a look at why the UK Prime Minister Rishi Sunak is facing last-minute calls by cabinet ministers to change the Conservative manifesto. That's next, and this is Bloomberg.
Politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Now, the UK Prime Minister Rishi Sunak faces last-minute calls by cabinet ministers to add new tax cuts and a tougher migration policy to the Conservative manifesto. Well, Bloomberg understands that early drafts provoked disquiet over the lack of big-ticket pledges that might prevent a heavy defeat ahead of the general election on July the 4th. Well, Bloomberg's Phil Aldrich joins us now. We also go to Anna Andrade from Bloomberg Economics shortly on the latest UK wage data. There's a lot going on. I mean, for a country that's relatively quiet compared to the EU elections, and Phil, thank you for joining us. So what is this manifesto for? Because the Tories, Phil, are so far behind in the polls, election a reminder, July 4th, that what are they trying to do with it?
Well, you got to remember that, yes, because they're so far behind in the polls, they're playing catch-up. They're trying to get people's attention. And Labour, so they've got two different manifestos this week. We're going to see the Tories, which is going to be chock-a-block full of policy ideas, and Labour, which there'll obviously be some interesting policy stuff in there, but predominantly they just don't want to rock the boat. They're ahead. Their goal is to keep going steady, and the Tories need to just catch people's eye. And so, yeah, and they need to both pick people from the right, so the reform, the voters who are shifting to reform, and keep the centre ground. It's a very difficult needle to thread.
So it feels like there's like 5 Conservative parties within the Conservative Party, right? Who's calling the shots on the manifesto? I mean, of course, Rishi Sunak, but then who's he trying to please?
Well, there's a lot of advisors behind the scenes who've been sort of tinkering away at the details. He's going to be trying to win over the sort of he's going to show that people should have faith in Tory capitalism. The home ownership issue, which is very much a Margaret Thatcher, Nigel Lawson type idea. He's going to be pushing for that. He's going to go for lower tax cuts, so working families. He's saying that he's going to say welfare needs to be trimmed to pay for all of this. So it's kind of a strivers, not skivers type of message, which appeals to the right. And then he's going to go to the migration issue. He's going to put caps on migration, we think, and so that's obviously an attempt to bring that part of that wing of the party in as well. So it's very difficult. He's going to try and grab them all, right. But he's got a lot of work to do.
And they've been in power for over 13 years. So you kind of think, the latest manifesto, is that what people are really voting on? We're no spin doctors, but maybe common sense dictates.
It's a track record issue, isn't it? I mean, and incumbents everywhere are across Europe and America are getting voted out. People are want a change. They want change, and here in the UK that seems pretty clear.
And one of the things that people will be looking at is of course the employment figures, which was worse than expected. I mean, what does that mean for Bank of England? But what does that also tell us the state of the economy is?
Yeah,
Let's go to Anna, then I'll get you in, Phil.
Sorry, yeah, so in today's data, I think the most important point for the Bank of England will be really the wage print and the private sector wage growth, and that came in below what we expected, and it leaves the forecast. The BOE doesn't produce monthly forecasts, but it leaves the quarterly forecast on track for the second quarter. And that's good news, because there was a bit of a threat that this month in particular, April, because we saw the increase in national living wage, and because a lot of pay settlements come through, there is a bit of a threat that it would actually be a sticky one. But it's this data showed that the trend in wage growth is down. That's reassuring for the BOE, although it's unlikely to be enough. What the BOE needs to see as well is services inflation sort of ticking down as well.
Anna, can you give me a sense on whether that brings forward the likely cut? I know the Bank of England, a lot of commentators say they were late to hike. Are they now too late to cut if the data keeps on getting worse?
No, I don't think so. Obviously June could have been sort of the earliest window to cut, but now because of the election, it's not going to be. And I think in terms of, the labor market is losing, and the Bank of England will sort of, react to that, and that supports our view that, probably the Bank of England will cut by more than markets expect. But I still think that there's a big sort of question mark around, whether inflation is on a durable path to 2% or not. And the wage growth series have been volatile. So, the Bank of England will want to wait for headline inflation to come to 2% and then cut after. So I think, we're talking about August here, so it's not, a major delay in terms of cuts. So there's not a major risk in terms of a policy mistake.
So, Phil, how would you describe? If the economy is slightly, going through not a downturn, but a softening, it was maybe the right call to call election July 4th on the Tory party.
Yeah, I think history may judge that it was a bit of a mistake. Doesn't look to have been working particularly well. But the wage, the labour market data today, actually, I would have thought would give Rishi, good reason for a little bit of a boost. Real wages are rising now for 10 or 11 months in a row. The fact that there is a softening in the labour market, but unemployment still remains relatively low historically, suggests that the Bank of England can bring forward those rate cuts. Maybe he should have waited so that people could actually have experienced those rate cuts and the rising, a few more months of rising real wages. But
I'm so glad we're not spin doctors. It's kind of like impossible to call. Yeah. An economist is a hard enough job. Phil and Anna, thank you both for joining us. Phil Aldrich and Anna Andrade from Bloomberg Economics. Coming up, EU leaders are eager to resolve top jobs after the election. Now, what happened in France, does that complicate the negotiating? We'll do that next. This is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
After Ursula von der Leyen's party won the most seats in the EU elections, she'll be looking to clinch a second term as European Commission president. That's as EU leaders look to resolve top jobs talks as soon as possible. Well, joining us now is Bloomberg's Oliver Crook, who's in Berlin. So the problem, Ollie, is that this is like horse trading. She has enough seats, but she doesn't necessarily have the majority of the heads of state. So what kind of trading is going on behind closed doors?
Yeah, that's right, Francine. So the EPP came out really the dominant force politically in the European Parliament. But as you know, Francine, in European politics, nothing is quite that simple. So what happens now is the horse trading. But first, what needs to happen before that is within the groups of the Parliament, where will each of these parties sit? And there was a lot of attention being paid to the AfD, the Alternative for Deutschland, which did very well, now commands 15 seats. Remember, they were ejected from the far-right group of the EU Parliament ID group because one of the leaders of the AfD was saying that basically not all members of the SS were criminals. They have since booted him, again, in order to try to clean up that party, in order to make it fit in one of these blocks. What I think is interesting, Francine, is at the national level, because this comes down to leaders as well, Macron is not even close to as emboldened as he was previously. Remember, he was floating around Mario Draghi as a possibility. And of course, the sort of national leader with the greatest mandate out of this is Giorgia Meloni. So these are the two sort of interesting factors injected into the conversation about EU Commission president.
But in terms of timeline, does it also just postpone everything because Macron is busy with a little election around the corner?
Yeah, well, listen, that definitely complicates things. I mean, I think it's a very interesting move by Macron. I think there's different ways of sort of viewing it and what the sort of possible outcome is. I think that Macron, in part, is relying on this sort of historical tradition in France to sort of barricade the National Front, as it was once called, now the Rassemblement National. Also, maybe on the idea that people in France are willing to vote for something at the EU level, but not the national level. But I think that it doesn't take into account some of the other points, which is this is a legislative elections. It's not seen as high stakes. Maybe people are more willing to take a little bit of risk there. So this is all sort of coming to a head. And Francine, in only 2 weeks' time, he doesn't have that much time to change the electorate's mind.
He doesn't. Let's see what happens. Thank you so much, our Oliver Crook there in Berlin. Now, Bloomberg Brief, it's up ahead because they'll have full markets roundup. There's also a conference going on in Berlin with Vladimir Zelensky and, of course, Olaf Scholz, the German chancellor. Then we look at markets. It's going to be a big day tomorrow. We have Fed, and then we have some data in the U.S. Von der Leyen, the president of the Commission, speaking at the Ukraine Recovery Conference right now. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well,
that started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Was going to keep Great World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg. Good morning from our global headquarters in New York. I'm Danny Berger. Manish is off in the sun somewhere. Welcome to Bloomberg Brief. Let's set your agenda. Apple Intelligence, the iPhone maker, unveils its AI push. Elon Musk says he'll ban the OpenAI-equipped devices from his companies. The UN gets on board. The Security Council adopts a ceasefire plan for the Israel-Hamas war crafted by the U.S. And the Federal Reserve kicks off its 2-day meeting. Investors await a rate decision along with the latest inflation data. So you got the pitch from Cook yesterday. Tomorrow, you get the pitch from Powell. What are bond markets doing in the meantime? You are seeing yields down by, let's call it 4 basis points. 4.42% is where you are on your 10-year yield. Calm after the sell-off yesterday in Europe, fueled by elections for the European Parliament and a snap election for France. Sorry, France, you get no respite in your bond market. Yields ticking higher by 6 basis points. The spread between Germany and France widening even further. So do you want to go in and buy European bonds now? Bill Gross certainly does. The S&P, that is down 0.2%. The type of volatility priced in for this market for Wednesday is quite remarkable. Citi's Stuart Kaiser talks about the biggest move being priced in for either direction since March 2023. JP Morgan says that we could see the biggest moves for the week, something like 1.4% off the back of, again, CPI and then Powell. Oh, and don't forget, you got a 10-year bond auction today and then a 30-year bond auction on Thursday. So plenty, perhaps, to be concerned about if you are a pessimist among us. Brent crude, that is steady after huge gains yesterday. At one point, nearly 3%. It was its biggest gain since March, perhaps a little bit of dip buying going on after some of the recent declines in Brent crude. So there's a lot for you to navigate. It's not just the economic data. It is not just Powell, but it is also the elections. We've had a taste of what the volatility could look like, and we're going to get a big election in the U.S. Adana Apio, portfolio manager at First Eagle Investments, writes this, that U.S. elections are a ways off, but there's significant uncertainty around tariffs and fiscal policy. It will make rate setting more challenging for the Fed as we move into next year. And she joins us now. Adana, thank you so much for joining us. Kind of bright, but definitely early this morning. I think this is so important because we're trying to wrap our heads around what happens at the end of this year with data that's maddeningly inconclusive. But 2025 is this huge unknown. So how do you even begin to position for something like that when we just don't know what it'll look like?
You know, I think we have to recognize, to your point, that there is a lot of uncertainty. And so we have to make sure we're investing for multiple states of the world. When you think about the upcoming election, depending on the outcome, it could have very different outcomes for tariffs. And then on fiscal policy, we know that the tax cuts are expiring at the end of 2025. So over the course of the year, there have to be, very difficult decisions made about extending those tax cuts or not, continuing with some of the big expenditure packages under Biden or not. And of course, the elections are going to make are going to make those outcomes, very different.
I mean, if you even look at, as I mentioned, the elections we've already had from Mexico to India, both of those saw big moves in the peso and Indian stocks respectively. We have European and now French elections that we have to deal with. It's a market that's been moving dramatically to results that were largely expected, maybe little differences here and there. What's that about? Is it just complacency?
So, I would, at First Eagle, we've been arguing for some time there's been complacency in markets when you look at valuations and equities or credit spreads or even term premium and sovereign bond markets. They're really not pricing these, very large political risk, obviously a lot of geopolitical risks as well. So I think you are seeing these reactions. If the outcomes of the elections aren't going exactly like markets are expecting, we're getting these reactions. And as you mentioned, upcoming elections, UK, France, then the US, plenty of room for volatility.
Well, I've heard the argument, look, obviously when it comes to Trump versus Biden, they are very different people and it is consequential who is elected. But in terms of policy, fiscal policy will continue to be loose. Protectionism is the trade, regardless of who's in the White House. So it doesn't actually make a difference for your portfolio who's elected. What's the argument against that?
I mean, I think it does make very important differences. Protectionism, maybe the degree, how much globalization is advancing or decoupling. That makes big differences for inflation, outcomes, which of course matter to the Federal Reserve and other major central banks. And on fiscal policy, we are going to have to make some very difficult decisions this coming year. And if either, whoever wins decides not to make those decisions, then perhaps you see more of a reaction in the bond market.
Well, to that point, I mean, we have had this huge supply of duration come to market. Today, we're getting 10-year yields. On Thursday, we're getting 30-year. With that increased supply and a dearth of volatility, we still haven't seen any of these big events. Sure, we get a slight sell-off when the auction doesn't go as good as planned. Is that as bad as it gets?
I mean, I think we can just look back to last year when we saw the more extreme sell-off in rates. Then you have the example of sort of the trust government when there's a real extreme reaction to negative fiscal developments. I don't think we should be complacent. We're still cautious on duration, despite sort of an economic outlook that might call for extending duration, given these very large fiscal risks that are overhanging. And as I said, term premium really not compensating you for lending to the government at longer level at higher.
Well, but I mean, again, this is something, to your point, given the uncertainty of 2025, doesn't feel like it's going away anytime soon. So what does that mean for a bond's place in a portfolio? Because usually this is the staid asset class. It's not going to move that much. It's low volatility, especially if you do any sort of volatility targeting. It's going to get a big weight in your portfolio. So has its place in a portfolio structurally changed?
That is a very good question. So I think it still has a role in the portfolio. We have been keeping duration short, as I think many might be, because the curve is inverted. It gives you a lot more optionality. Perhaps waiting for credit spreads, which have remained very tight, waiting for credit spreads to widen in order to sort of reorient the portfolio.
Right. By the way, to the point of volatility induced by elections, the France-Germany 10-year spread, as we've been talking, has jumped to the highest since October. So you're really speaking to the right crowd now of the volatility in these bond markets. But it really has been a yo-yo narrative for markets. When we get CPI tomorrow and the Fed decision, is that going to solidify us either way? Or is it going to continue to be a back and forth and a choose your own adventure, interpret the data how you want?
I mean, I think the CPI report tomorrow is critical. If we get a print that's in line with April or slightly worse, as Waller sort of deemed like a C+ report, then I think it likely scuttles a September rate cut. However, if we get something a bit better, then I think it leaves September wide open. So I think we will have, and we'll have 2 more inflation prints before the September meeting. So I think the data will still be influential, but I think these, the data that's coming in will be influential for sort of the course of monetary policy for the rest of this year. But then, as we discussed, into next year, you have these big political events.
I mean, we can't forget the BOJ. It's easy to forget because Wednesday is so big. I know we have to get through that first before we can get to the BOJ. You've started to take down some of your yen hedges. What's your thinking there?
Look, I do think the Bank of Japan is closer. I think that we're starting to see in the data more influence of wage hikes, and that is feeding into service sector inflation. I think this gives the Bank of Japan room, perhaps at this coming meeting, to start to taper its balance sheets. I think we'll get some announcements there. And then probably in the next meeting or 2, maybe another rate hike, which, if you had asked me 6 months, a year ago, I would not have thought they would have been able to move as dramatically. So for us, the decision to remove the yen hedge reflects that we think these interest rate differentials that are very wide between the U.S. and Japan are going to start to narrow from here, slowly, but start to narrow. And the extreme undervaluation of the yen from a fundamentals perspective can then re-exert itself.
Right, and we know that this is a BOJ who pays attention to the yen. I mean, they somewhat have to, given the noise coming from the government. We've had folks come on this program and say, look, it can't be a one and done in terms of a hike, because if that's what they signal, then weakness reignites itself for the yen. So is this a BOJ that needs to make clear that this is the start of a cycle?
I think the time has come now. I mean, recognizing, all central banks operating under tremendous uncertainty, none more so than the Bank of Japan, but it is time for them to lay out a framework. How are they thinking about exiting from extraordinary monetary accommodation, very large balance sheet, interest rates at still basically zero. So what is their path? What is the strategy? How are they going to evaluate data? They haven't laid out that framework, but I think the time has come. And that uncertainty, as you see, views are all over the place. I think that uncertainty is weighing on the yen.
Right. Listen, no one will be happier about softer CPI and a dovish Powell than you, Ada. So, hopefully he has that to look forward to. Donna, thank you so much for joining us this morning. Really appreciate you coming in early. That is Adana Apio of First Eagle Investments. Okay, let's get you some of the other top stories that are trending on the terminal this morning. A Moelis employee is on leave as the bank investigates an incident. There's a video circulating online that shows a man identified as one of the firm's senior bankers appearing to punch a woman. The New York Police Department says no complaints have been filed on the incident. A New York City office building owned by a related affiliate is set to be sold at a steep discount. According to people familiar, Empire Capital and Namdar agreed to purchase the property at 321 West 44th Street for less than $50 million. That's a roughly 67% discount from what was originally paid in 2018. And Golden Goose, the luxury sneaker maker, and its shareholders are seeking to raise about 558 million euros in its IPO. That gives them a market valuation of about 1.9 billion euros at the high end. Bloomberg reported earlier that Golden Goose could be valued at about 3 billion euros, which Manus and I asked the CEO about, and he told us that he was happy with that valuation. Okay, coming up, Apple strikes an accord with OpenAI. Elon Musk doesn't like the sound of it at all. And later in the hour, we're going to catch up with Aaron Kennan, CEO of Clear Harbor Asset Management. Again, we're all gearing up for Wednesday, the fireworks show that is CPI and the Fed. This is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m. only on Bloomberg Television. Context changes everything.
It's your Bloomberg Brief on this Tuesday morning. I'm Danny Berger in New York. Apple has unveiled its long-awaited suite of new AI features, and that includes a partnership with OpenAI, the maker of ChatGPT. Here's what Tim Cook had to say about getting generative AI into your Apple phones.
Recent developments in generative intelligence and large language models offer powerful capabilities that provide the opportunity to take the experience of using Apple products to new heights. Introducing Apple Intelligence, the new personal intelligence system that makes your most personal products even more useful and delightful.
Let's get more on this story with Bloomberg's Kriti Gupta, who joins us now. Kriti, great to see you. First of all, Dan Ives, he's an Apple bull, so maybe we expected this of Wedbush, calling it a historic day, that it changed the game. But did it do enough to boost sentiment? Did it really change the game when it came to how investors are approaching Apple and its outlook?
Well, if you look at the share price, the argument is absolutely not. In fact, one of the criticisms of Apple has been they're late to the game, and they have been for a very long time, putting their money in other things like a self-driving car, for example, or even ramping up their design cycle to the point that they're almost cannibalizing their own products. Those are the criticisms of Apple and kind of their development plan. AI has been kind of further back on their agenda. Now compare that to the likes of Microsoft or Alphabet or even Oracle, for example. We're going to hear from them later today. You've started to see the AI push much more aggressive. Apple, even Amazon, has been accused of being further behind. So for that reason, there was a lot of anticipation ahead of this event that perhaps this would be the big game changer where Apple and Tim Cook and, of course, the C-suite there would prove investors wrong. And that didn't really seem to be the case when you look at the share price.
Well, when you talk about the catch-up argument, it goes something like this, that now Apple has to move really quickly, and they can't be as thoughtful as Apple usually is in terms of both design and safety. That brings in Elon Musk's threat. Because of safety, he says that he wants to ban Apple devices that are backed by OpenAI from any of his companies, that you're essentially going to have to put them in a lockbox if you try to enter, I guess, X or Tesla or SpaceX. What do we make of that threat?
Yeah, he didn't exactly explain the logistics of how you enter the office building if you've got a smartphone, given that most Americans do actually have smartphones. I think what's important to note here is that there is a history behind Elon Musk saying this. Remember, Elon Musk and Sam Altman kind of developed a lot of the early startings of artificial intelligence, even OpenAI together. They did have a falling out, and since then, both have actually been very critical about the dangers associated with OpenAI. So some of the criticisms of Elon Musk's criticism is also saying that perhaps he has a little bit of a personal vendetta there as well. On the other side of this, though, you can see where he starts to struggle simply because if you look at the way he's approaching Tesla or some of his other projects, he's very careful about introducing AI because there hasn't been that much regulation for it. Apple, on the other hand, is really only talking about bringing this in later in this year, perhaps going into 2025, and doing it via their Siri product. And remember, if you're like me, I'm a little old-fashioned. I actually have Siri disabled on my phone. So for that reason, it's actually the criticism of that criticism would be that perhaps it's not as big of a risk because you can turn it off if you don't want it.
You have Siri disabled, Critty.
I felt like I was relying a little too much on autocorrect and things like that. So, you know, to save the spelling, to keep the spelling intact.
Good for you, because I literally cannot spell for my life. Maybe I should do the same, but I'm literally like a grandpa with my phone. I'm like, Siri, what's the weather? I'm too lazy to swipe and open it. So I think one of the few people actually uses it. Hey, Critty, thank you so much for joining us this morning. That is Bloomberg's Critty Gupta. Let's get back to these markets, specifically the France-Germany spread. While the rest of the bond market calms down from the impact of the European parliamentary elections yesterday, alongside some hawkish speak from ECB members, unfortunately for France, the selling pain is not over. Yields are still moving higher in France. That means that the spread between Germany and France continues to blow out. We're now at the highest level since October. That is quite the jump up you can see there at the end. We're just speaking with Idana Ideo, a First Eagle, who says that this is a complacent market, hence some of the reaction that you are getting to these elections. Meanwhile, bond markets, again, elsewhere, they are calm while stocks are slightly lower. We're going to get a 10-year auction today, but the fireworks come tomorrow in the form of CPI and the Fed. Okay, coming up, geopolitics for you. The UN adopts a U.S.-crafted truce as Secretary of State Antony Blinken arrives in Israel. We'll have more on those ongoing ceasefire talks next here on Bloomberg Brief.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg. From the world of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
It's your Bloomberg Brief. I'm Danny Berger in New York. Manus is out this week, no doubtedly on a sunny beach somewhere out there in the world. Let's get to your front page news now. A look at what's making headlines around the world. First up on the Bloomberg, the peso taking a hit. Mexico's President-elect Claudia Sheinbaum is going to be prioritizing several constitutional reforms. The reason the peso is selling off, weaker by about 1% this morning, is that there's concerns about major changes to the judiciary. And so far, since she was elected, peso weaker versus the dollar by about 8%. Next up, we have the Washington Post leading with this. Donald Trump was interviewed by a New York probation officer over video yesterday. He got special exemption to do that from Mar-a-Lago. The probation officer's sentencing report will help a judge decide how much time, if any, Trump will spend behind bars. I love this. According to a person familiar, the event was uneventful and lasted less than 30 minutes. And then, leading on the New York Times, the UN Security Council has adopted a U.S.-backed Gaza ceasefire plan. The vote comes as Secretary of State Anthony Blinken visits the Middle East. Let's get more on this story now and bring in Jomana Bersecci, our Horizons Middle East and Africa anchor. So, Jomana, as I just mentioned, Blinken is visiting Israel. It is his 8th visit since the region, since October 7th. Where do we stand?
Yeah, that's right, Danny. His 8th visit since October the 7th. He is essentially in the region once more to shore up support for that Biden truce, the proposal that was put forward on May the 31st. Blinken was in Egypt yesterday meeting with President Sisi. He then moved on to Israel, had some meetings with the Prime Minister Netanyahu alongside the Defense Minister and even Benny Gantz, the minister who actually left the government over the weekend. And it seems as though things are moving in the right direction. A short while ago, Blinken was giving some commentary to reporters, and he said that he had received commitment from the Prime Minister that they would be happy to proceed with the discussions on that ceasefire proposal. And so far, the signals that are coming through from Hamas is that they're happy as well to proceed with indirect negotiations. Now, the sticking point right now, Danny, is that there are multiple phases in this peace plan. There's phase 1, phase 2, phase 3. Phase 1 would entail a 6-week ceasefire and the exchange of some vulnerable hostages, including the elderly, children, and women. It seems like both Hamas and Israel are happy to sign on to phase 1. The major issue becomes what happens with phase 2 and that proposal of a permanent ceasefire. And here, Hamas are saying that they're not going to sign on to a permanent ceasefire unless Israel provides some sort of guidance or commitments that they're going to stick to it. Israel are saying that they are not going to sign on to a permanent ceasefire unless they've secured the release of all hostages and completed their military objectives. So there's still some daylight between the two sides, but the fact that Blinken is here shows that some progress has been made.
And this also comes a day after Benny Gantz left the War Council, who had been perhaps a more moderate voice, and now Netanyahu has to rely on those more far-right voices in the War Council. What difference does this make as we start to talk about ceasefires, as we start to talk about what Gaza looks like post this war?
Well, we published a report, our BN colleagues published a report yesterday saying that even though Benny Gantz has left, ultimately the government will survive in its present format. Netanyahu's government still has a majority within the Knesset. And so it isn't going to lead to an imminent dissolution of the Netanyahu government, but it does tell you that he perhaps is more susceptible to some of the views of the more hawkish members of the government, including the likes of the National Security Minister, Ben-Gvir, who himself put his hand up and said that he wants to be a part of the war cabinet after Benny Gantz's departure. So certainly a lot of pressure from within the government not to sign up to the ceasefire proposal, but international pressure is building, and that's what we need to watch out for.
Jomana, really appreciate it. That is Bloomberg's Jomana Bersecci in Dubai. Coming up, we get back to the markets, the double whammy of a CPI and a Fed on Wednesday. We're going to catch up with Clear Harbor's Aaron Keenan next on Bloomberg.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
From our global headquarters in New York, I'm Danny Berger. It is a Tuesday morning ahead of a big CPI day. Let's set your agenda. Apple Intelligence, the iPhone maker, unveils its AI push, but Elon Musk says that he'll ban the OpenAI-equipped devices from his companies. The UN gets on board. The Security Council adopts a ceasefire plan for the Israel-Hamas war, crafted by the U.S. And the Federal Reserve kicks off its two-day meeting as investors await a decision along with the latest inflation data. It is a calm bond market this morning. Calm after the storm that were European parliamentary elections yesterday, a snap election called by France, and more hawkish ECB speak. So we're down by about 4 basis points. 4.42% is where you stand on your 10-year yield. French 10-year yields on the bottom of your screen. No respite for them, still higher by 6 basis points. The spread between France and Germany is now at its widest level since October. Your S&P 500 futures, those are down by 0.2%. Analysts everywhere are saying that tomorrow will be an event of volatility, that options pricing are at the moment pricing in something like 1.25% move either direction for tomorrow, which would be the biggest move since March of 2023, that according to Stuart Kaiser of Citi. We also have some bond auctions to get through. Today we're going to get 10-year auctions, and then we're going to get 30-year auctions. Brent crude slightly weaker this morning, down by about 0.4%. Some big gains yesterday, nearly 3% off the back of who knows what, maybe some dip buying over a weaker overall oil price trend. So just two major central bank decisions. Keep in mind that we're going to get within 72 hours later this week. We got the Fed on Wednesday, the Bank of Japan on Friday. We already heard from the ECB yesterday. It has been a big month. Bloomberg MLive reporter Noor Al-Ali joins us now to look ahead. Noor, let's just first work through this U.S. calendar. We got auctions, we got data, we got a Fed decision. What kind of volatility is this going to bring us?
Quite a bit, right, Danny? Because, I mean, if you look at last week's hot jobs data, it's definitely thrown a wrench at the Fed's plans. I mean, reminder as well, we had from March the expectations from their dot plot of 3 cuts. Obviously, speakers since then have really paired those expectations for markets. Now, there is some potential that we may get 2 expected Fed cuts by the end of this year. But of course, markets aren't even fully pricing that. They're only fully pricing one 25 basis point cut, potentially sometime in November, and the odds of a second one are still not there yet in terms of being fully priced yet. And to be fair, you know, we've had a dismal auctions sales just last month. You know, there wasn't as much demand for the 3-year yesterday as well. So overall, we are seeing a bit of a poor picture here. Yields trending higher. I know they are lower on the session today, but all points are leading towards higher yields towards the end of this week. Now we're just looking at that CPI print and where it's going to head and how comfortable the Fed is going to be with CPI still nowhere near its 2% target. We're looking at core, we're looking at services inflation, and we're also looking at wages as well. So a lot to factor in for the Fed and so much up there up until the BOJ that's coming up on Friday. So quite a packed week here.
Well, we know no one would be happier about a soft CPI print and a dovish Powell than you, Wada, to help him along his journey to try to combat some weakness in the yen. Nor, we've also heard from plenty of ECB speakers following their decision last week. Christine Lagarde, Madame Lagarde said that we've made the appropriate decision, but it doesn't mean that interest rates are on a linear and declining path. Noggle talked about the Table Mountain metaphor being wrong. In this rate cutting cycle, is this different? Is this more of a mid-cycle tweak? And it's going to be some time before we see another cut from the ECB.
Yeah, look, I mean, Danny, if you look at the comments today from all the ECB speakers that we had Valeroy, we had Ren, and we had Simkis, all leaning more dovish, right? After the very hawkish cut that we had just last, apologies, they were leaning a little bit more hawkish after that hawkish cut that we had just last week. We had inflation projections being boosted for 2024 and 2025. Wages data also quite high, not comfortable within the levels that the ECB is pointing at. And we also have now a picture where the ECB is coming out and saying, well, look, we've just cut interest rates by 25 basis points to the shock of many in the markets who look at the data and think, well, the data is not there yet. But that doesn't mean that the ECB is going to continuously now start cutting. There will be months, as Lagarde said, well, they'll hold rates. And so it's going to be quite interesting. Money markets are now expecting the ECB to deliver at least one more cut by December. We're potentially looking at November or September, but still a lot of that is up in the air. And potentially the Fed can start now coming in with those views that will maybe sway the ECB as well.
Nor, appreciate it. Bloomberg's Nora Ali setting us up for the week and the week that was. Joining us now is Aaron Kennan, CEO of Clear Harbor Asset Management. Aaron, I mean, the data has been somewhat maddeningly inconclusive as to how many cuts we're going to get later this year. We're going to get CPI tomorrow. For you and for your estimation of where this Fed goes, what's at stake?
Well, it's interesting. Tomorrow is an important data point for sure, Danny. But we're going to have 4 more CPI data points before September. And I mentioned September because prior to the employment data on Friday, there was like an 80% chance of a cut in September. And after the strong employment report, it's now only about 50% of the first cut coming in September. So the Fed's going to have a lot of CPI data to look at and a lot of wage data to look at. We've certainly seen softening on the consumer side. And frankly, before the jobs data on Friday, we were starting to see either through the JOLTS, the job openings data, as well as other economic indicators like the employment cost index, indicates some incremental softening on the labor side, which the Fed on the margin is still looking to see, particularly as it relates to wages.
I have this really interesting stat. This is from Bloomberg and Live Simon Flynn about what reactions are usually after a day where you have a Fed Powell conference, that usually 10-year yields have decreased 88% of the time after the Fed meetings in the past 2 years. 2-year yields dropped 76% of the time, and that is a trend that has persisted in 2022. Aaron, I can't help but wonder if that's simply because that this is a Powell with a dovish leaning. Every press conference he comes out, regardless of the data maybe, and has to fight the inclination to be more dovish. So just in pure simple reaction to tomorrow's data, is it just going to be a race? If we have a strong data point come out, is that just undone by what we hear from Powell?
It's a great question. You know, we'll have to see. Clearly, we've made a lot of progress on the inflation front, Danny, and I think in some sense it's a human reaction that we sometimes hear during the Q&A from Powell. You know, we've come from 9.1% to 3-odd% in CPI and PCE numbers under 3%, and we've made so much progress since mid-2022 on inflation that there's a level of perhaps just sort of humanness that we're seeing come out of the Fed, which is often a hopeful view that the last mile will not take as long as many fear. And we'll have to see on that front. Certainly the MOVE index, the volatility index within the bond market, is still elevated relative to history, but it's been coming off a bit on the margin. There's been a little more of a range-bound trading seen since the April peaks in the marketplace. So, certainly will be interesting to see the summary of economic projections as well, which is, essentially what does the aggregate FOMC believe as it pertains to the rate vector going forward.
Right. When it comes to this equity market, we had an earnings season that you got punished if you missed, but overall earnings weren't that bad. The big factor in equities falling was rates volatility. On this point, Aaron, HSBC writes this, that rates volatility is unlikely to spike to levels from last year, let alone from 2022. So we'd expect any weakness in risk assets to be both short-lived and shallow, and we think this presents a pretty good tactical re-entry point into risk assets. So Aaron, just to kind of sum up, their view is the impact of rates on equities, it's going to be short-lived this time around. What do you make of that?
Yeah, I mean, I think they're sort of saying that maybe rates did peak in April, that the general trend line is downward, it may just take a little longer, and that lower rates should help particularly the equity market asset class and credit. And, I don't necessarily disagree with that view. I would just, look under the hood. If you look at the forward multiple of the S&P 500, for example, it's trading at 21 times forward, which is top decile expensive. But if you look under the hood at the remaining, call it 490 odd names, it's only trading at about 16 and a half times. And so, it's a very top heavy market right now. NVIDIA represents a third of the entire return of the S&P this year. The top 10 names represent about 72% of the entire 13 odd percent return this year for the S&P 500. But there are a lot of opportunities beneath that. And I think lower rates certainly would serve as a nice tailwind for risk assets going forward. Particularly, also, I must caveat that with if we avoid a recession, if lower rates are a function of benign inflation data rather than really weak economic data.
Aaron, I was going to say, I feel like this should be a caveat over everything we talk about. If there's a recession, it will change a lot. Aaron, I'm afraid that's all we have time for. Thanks so much for joining us. Aaron Kennan of Clear Harbor Asset Management. Okay, quick look at your Treasury market this morning. It is more calm compared to yesterday. Your 2-year yield down 4 basis points. For most of the curve, that's what it looks like, 3 basis points on the long end. We get a 10-year auction this morning. French yields, though, still ticking up higher. And on the point of European debt, Bloomberg's Alex Steele caught up with PIMCO co-founder Bill Gross on his outlook for the 10-year note both in the U.S. and Europe.
I don't think there's much of a trade on treasuries. To my way of thinking, the 10-year, which is close to 4.5%, let's call it 4.5%, is dependent upon inflation, which we'll see on Wednesday, and we'll know more because of that. But if inflation is 2%, I think the 10-year belongs close to 4%. If it's 3%, it belongs closer to 5%, and we're right in the middle. So at the moment, with 4.5% 10-year treasuries and break-evens around 220, that's a 470 basically break-even for the nominal 10-year treasury, and I think we're about there. There's not much to be done until we know more.
Bill, what are the chances that we see, say, the median dot in 2024 and 2025 actually move higher? I mean, do you think there's a possibility, and what would be the reaction to something like that?
Well, I think it would be negative. The Fed has basically signaled they're sort of done, perhaps 95% done in terms of raising rates. It's not that they can't raise them if the print on CPI isn't bad for the next several months. But, I think the market basically anticipates the Fed to stay, and maybe in September, maybe in December, maybe 1 or 2 cuts if, the current numbers continue as we've seen them.
That is Bill Gross. By the way, he went on to add, because he clearly doesn't see much range for this bond market, that Europe is the land of bond opportunity, given that yields have moved higher in Germany, and there's opportunity there with the divergence between the U.S. and European cycle. But the bond king, for what it's worth, is more of the stamp king now. He's got an auction coming up of his stamps on Friday of $20 million. Okay, coming up, it's Apple striking a chord with OpenAI. Elon Musk says that he would ban their devices on safety concerns. We're going to catch up with Matt Bloxham of Bloomberg Intelligence on that next.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
It's your Bloomberg Brief. I'm Danny Berger in New York. Manus is off today, dreaming of his new AI-powered iPhone, I'm sure somewhere out there in the world. On that, shares of Apple, they are lower in the pre-market, less than 1%. But investors have shrugged off the tech giant's AI announcements, maybe because they were largely expected. There, Apple unveiled a suite of new features, including a partnership with OpenAI, the maker of ChatGPT. Here's CEO Tim Cook on getting generative AI into Apple devices.
Recent developments in generative intelligence and large language models offer powerful capabilities that provide the opportunity to take the experience of using Apple products to new heights. Introducing Apple Intelligence, the new personal intelligence system that makes your most personal products even more useful and delightful.
Shortly after that, Elon Musk tweeted that he would ban Apple products, or posted on X, whatever the language is now, that he would ban Apple products which integrate Sam Altman's software at the OS level. Let's get all of this with Matt Bloxham from Bloomberg Intelligence. Apple Intelligence. I mean, they're coming for your job here, Matt. Bloomberg Intelligence, Apple Intelligence. Yeah. But how much do we glean of what Apple Intelligence is really Apple versus just an open AI offering?
No, I mean, I think this is very much Apple at the core. You know, I think the ChatGPT OpenAI part didn't really get a huge amount of airtime yesterday. I think that was intentional because really what Apple is selling here is largely an on-device AI platform with a carefully managed kind of cloud layer around the outside when it's needed. And that's quite a big differentiation to the kind of the rest of the generative AI platforms we've seen out there. So I think, yeah, they want to give everybody the best of both worlds, if you like, but even the implementation of ChatGPT has some guardrails around it to protect people's privacy. So, you know, I think very much from Tim Cook's perspective, this is an Apple development that's essentially at the core of what they're offering here.
I want to get to the OpenAI and privacy question in just a moment, Matt, but usually Apple is not necessarily the pioneer of new technology, but it's the company that comes in and makes it sleeker and better. The iPod is a great example of this. The idea that MP3 players were already out there, but then Apple comes in and introduces the iPod and has this really sleek version that gets people excited. So AI, it's not necessarily the pioneer, but did we get a sleeker, better version of its integration?
Yeah, absolutely. I mean, you know, if you look at all of the different features that Apple have announced as part of the platform, they're very familiar. You know, it's things like summarization, automated kind of, you know, suggestions of how to reply to an email, ability to kind of edit photos more intelligently. So they're all things we've seen from standalone businesses. And as you say, Apple's been quietly working its own versions of those in the background and is waiting to release them until they think that they're ready and they're going to give users a really kind of high-class experience. So that's what we're seeing. So, you know, it's going to be a kind of an evolution of the operating environment that everybody's familiar with if you're an Apple user, and it's going to elevate all of those core applications, messaging, email, Safari, Siri, photos, all these applications that people use on a daily basis is going to make them better, enhance them in a gradual way, really.
Maybe it is finally time then for me to upgrade from my iPhone 12. Just quickly, Matt, on the security risk with OpenAI, you say that they introduced guardrails. Elon Musk says it's dangerous, you can't bring it in, an OpenAI OS device into any of his companies. Which is it?
Yeah. I mean, it's a good question. We'll have to see the real detail of actually how the kind of technology is working in the background. But, you know, if you look at what Apple's saying, they're saying that IP addresses of the user will be masked and that ChatGPT won't be holding on to the searches or the queries you make of it. So that's quite different to how ChatGPT works if you're a kind of standalone subscriber to their system. So they have been thoughtful about it. I mean, obviously, Elon Musk has some legitimate concerns about the future of generative AI, but whether there's anything really to worry about in terms of how Apple are implementing it, I think we'll have to wait for the kind of real software experts to kind of unpick that.
And we do know Elon Musk can hold a grudge. He doesn't get ad dollars on X from Apple anymore, and he has his own AI startup. Matt, we're going to have to leave it there. Matt Bloxham from Bloomberg Intelligence. Not Apple Intelligence, Bloomberg Intelligence. Thank you very much. Let's stay with tech. Oracle is going to report fourth quarter earnings after the market closed. Let's bring back Bloomberg's Kriti Gupta on this. Kriti, what are we expecting?
Well, we're expecting them to impress. The bar is actually high. When you look at some of the numbers here, I'm going to look down for a second. Analysts projecting sales are going to increase by about 5% to about $15 billion in the last 3 quarters. Now, this is a really big deal because we know when it comes to AI, when it comes to cloud, Oracle's competing with some of the biggest players in the business, Microsoft, Alphabet, AWS as well. Oracle's kind of seen as this old guard tech company, the likes of Dell, HP, for example, the ones that were really booming in the 90s and then kind of lulling a little bit. It was actually, however, in kind of the forefront of cloud and the transition to cloud. Now they have to really prove that they have what it takes to really compete with the big boys on AI, and that's the bar they have to meet in their earnings report today.
We've seen other earnings in this sector, in cloud, in software, get absolutely pummeled if they don't have an AI offering that is monetizing itself. Given what we've already heard from Kriti, how likely is it that Oracle can show up and outperform, as you say, the big boys?
Yeah, well, Oracle is making some pretty decent kind of moves in terms of gaining market share. Remember, it's competing with Alphabet's competing with AWS and Microsoft as well. Now, Microsoft and AWS, so Azure and AWS, I should say, are going to be your dominant players in cloud. Oracle is directly mostly competing with Alphabet. The problem that Oracle has is it's got a little bit of an overhang on it when it comes to its Cerner business. This is a company that they acquired back in June of 2022 that would really has everything to do with health records. The idea here simply being they were going to bring this kind of old-fashioned healthcare record system into the 21st century and do it via cloud. The problem is that infrastructure is taking far longer to implement. So that growth prospect that analysts are talking about, they're hoping that this is the last quarter where there's going to be that overhang, and then from here on out, it's much bigger jumps. But again, Danny, the bar is high for this company.
Kriti, appreciate it. Bloomberg's Kriti Gupta there on Oracle earnings. Again, we get them after the bell today. Coming up, we're going to hear more from the ECB. Plus, it's a Treasury bond auction today. A lot to look forward to before your CPI Fed Mega Day here on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's your Bloomberg Brief. Danny Berger in New York here. Let's get a look at what is ahead for the day for you. We're going to get more remarks from ECB members on deck. That will include Holtzman, Villeroy, and Lane. We heard from quite a few yesterday, including Madame Lagarde, who said they're not on a linear path. Then $39 billion of 10-year bond auctions. That's at 1 p.m. Eastern. Plus, there's just speaking with Kriti Gupta about we're going to have Oracle earnings after the market close. Let's get some individual stock movers for you, too. Eli Lilly, that is extending its rally up nearly 3%. The FDA advisory panel unanimously voted that Lilly's Alzheimer drugs have benefits that outweigh its risk. The final decision is expected by the end of the year. Cleveland Cliffs, that is dropping. JP Morgan has downgraded the steel producer to neutral. They've cut the price target from $23 to $17. Bill Peterson, the analyst there, says that forward pricing is likely to be weaker than previously expected. Let's get back to these European bond markets. Unfortunately for France, the rest of the bond market has been calm, while France is still selling off. The spread at the moment is at the widest since October. It's not going anywhere. By the way, a headline just out that a French person close to Macron has denied a report about his resignation. There had been some perhaps rumors he'd resign if he lost the French assembly election, that according to the Times. So French bonds continue to sell off. That's it for the brief. Surveillance is ahead.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. But we do a breakthrough. We look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is that we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
I think we're in this sort of phony war right now where there's just a lot of uncertainty on the data.
I don't want to overreact to 1 month's number. If our base case is that economic activity is slowing.
You just really need to pay attention to valuations in a way that we really haven't had to.
The economy is still chugging along.
Why sacrifice the economy to the altar of a 2% inflation target if you don't need to?
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Bloomberg Surveillance starts right now, live from New York City this morning. Good morning for our audience worldwide, with equity futures negative by 1/3 on the S&P, closing out yesterday to start a new trading week at all-time highs on the S&P 500 and the Nasdaq 100, just as the two-day meeting kicks off for Chair Powell and the Federal Reserve. We begin this morning's program in Midtown West. Here's the address for you: 321 West, 44th Street, Manhattan. Bramo, tell us why we begin the program in Midtown West.
Well, it goes to sort of a bigger theme that we've been talking about for a long time, which is where are we in this commercial real estate reckoning? And basically, this is a New York City office building that also had the studios of P. Diddy on the second floor that is being sold for less than $50 million. compared to north of $160 million back in 2018. That is a 67% discount. Again, it raises this question of, okay, is this beginning? Is this a middle? Is this idiosyncratic? Or are we just basically in the early stages of this reckoning?
So help me understand this transaction. This is less than what's left on the loan.
Correct.
Right, the loan is still $100 million.
Correct.
So this is like another example of the last 12 months of this slow-moving train, this sort of rolling stress from one sector to another, from one zip code to another. It started with the banks last spring, sort of got through that, stumbled on. Then we had a little bit of a hiccup in the Treasury market, September, October time. We moved on. You're going to see a few things like this. Can we keep moving on? I'm thinking of Mark Zandi of Moody's yesterday. You quoted him. That sticking plaster, we're just sort of holding on the system right now. Is that what this is?
Duct tape, this idea that we don't have any mobility whatsoever in a lot of the real estate markets. This is what people are hooking into. At the same time, I was speaking yesterday to an investor who said that her impression was we were in the 6th inning of this commercial real estate reckoning. And then she spoke to some analysts who said, no way, we're in the 3rd or 4th inning. We are just beginning this. And that's sort of the uncertainty underpinning the question that you and I have been asking for a long time. How is it that we can get rates this high with no reckoning whatsoever in a credit market that grew up out of a period of very low rates?
So if you look at the household survey and the labour market, things are terrible. You look at the establishment survey, things are great. You look at the US equity market, things are fantastic. You look at commercial real estate, things are terrible. If you're the chairman of the Federal Reserve, the bifurcation that you're seeing in the economy right now, what on earth do you do to set policy, not just for the next couple of months, the next 12?
You don't do anything, which is what a lot of people are expecting today, is that basically they're going to hold tight. Stephen Major over at HSBC put out one of his bond letters, and I thought it was really compelling. He started talking about narrative fallacy, this cognitive bias in humans. We hook on to any data point and we create a narrative around it. And that's the reason why we've been creating a different narrative every single day, because we get different data points that can edify that. And he's saying basically, if you look at the big picture, inflation has been trending lower. The economy is still strong, but softening around the edges. And the question is, and this is really the question for Jay Powell, when does the bias shift to fighting inflation to fighting growth concerns? And that is really the tipping point that a lot of people are looking for.
It's the conversation we had for most of last week until Friday morning at 8:30 Eastern Time when the jobs number dropped. Let's turn to a single name. That will be a big question for us this morning. I want to talk about Apple. It's down in the pre-market. We're negative by 0.7%. It was down yesterday by close to 2% at the close. Apple unveiling the longer-awaited AI features. I've got a list of them. Revamped Siri, partnership with OpenAI. We reported that here at Bloomberg. They're going to summarize text, create original images. It's called Apple Intelligence. Did you like that?
Well, it's sort of buy the rumor, sell the news. It was a little bit of that because people were saying, well, it didn't add that much that was new. Sort of a personal assistant touch, sort of a cross-referencing of some of the messages as well as some of the apps. I thought it was interesting. This is what Samsung posted on their Twitter site yesterday. They immediately came out snarky. Adding Apple doesn't make it new or groundbreaking. Welcome to AI, followed by an Apple emoji. So, a little bit of snark, we've been here for quite a while. That said, wait till it comes out. The feature where you could share payments was pretty cool, I gotta say. Did you see that?
That's the bit that you liked. I missed that.
It was basically, if you wanted to pay your friend $20, you just have to sort of put your phones near each other, and then there's just sort of like a light that goes through.
Just sort of shoot 20 bucks over?
Look, I don't know how much this is going to move the needle.
That's not new technology, is it?
No, none of this is new. It's packaging. That's what Apple does best.
Got it.
That's essentially what's going on.
But are they going to do that this time around, like late but better? Because it doesn't feel that way this time around.
That's the correct point, right? They're late, but it feels like they're playing catch up. It's not as if they've been working on this the whole time to perfect it and make it beautiful and package it perfectly. There are also issues with Elon Musk and some concerns around security, and they're going to have to fight that on a sort of broader scale. But to me, this sort of shows how high the bar is right now to surpass expectations in AI adoption.
The stock a little softer again in the pre-market. The broader scores look like this. Welcome to the program. On the S&P 500, we're negative by 0.3%, just a little bit softer. Yields are coming in, a bit defensive out there. We're down 3 basis points, 4.4374. More weakness on the euro. We're down 0.1%, 107.54. And French bond yields, we'll take a look at them a little bit later, keep climbing. Keep breaking out. Spreads a little bit wider again versus Germany on the morning over in Europe. Coming up on the program this hour, we'll catch up with BlackRock's Russ Kostrick as the S&P 500 holds on to a fresh record high. Dan Ives of Wedbush on Apple's big AI reveal. And Blorina Urici of T. Rowe Price looking ahead to Wednesday's doubleheader. We begin with our top story. The S&P 500 reaching fresh record highs as traders place their bets ahead of tomorrow's Fed decision. Russ Kostrick of BlackRock saying this: we think markets are vulnerable to modest pullbacks on both sticky inflation as well as the pre-election trade as we get into late summer and fall election season. That said, we think the market can end this year higher. Russ joins us now for more. So Russ, let's start with the equity market picture, sir. You've been trimming since spring. I know you're still constructive on the stock market. Can you just walk us through where you've been pulling back just a little bit?
Absolutely. Good morning, Jonathan. Yeah, look, we still think the market's going to end the year higher. We're still in a bull market. You know, that said, we've taken a little bit off the table. We started doing that back in the spring. And I think it reflects a few things. One, the magnitude of the gains, the fact that you still have a lot of uncertainty around the Fed. And the sentiment is going to get a little bit more challenging as we get towards the end of summer and the early fall, and the market deals with the uncertainty of a very unusual election.
What about the election, Russ, are you concerned about? Because what we hear from a lot of people is that it's the bond market, not equities, and that's where the risk is. Is that how you and the team see things?
You know, I think the biggest issue is really simply the uncertainty that hopefully will be resolved once the election is over. You know, in terms of whether or not you're going to get aggressively long or short the market, it's generally been the wrong call. I think what you go back to are the fundamentals: strong growth, inflation that is moderating, albeit not in a straight line. But the reality is investors are likely to deal with some of the uncertainty in the run-up, and that often causes a little volatility in September and October.
Russ, it strikes me that we're talking about the equity market as a monolith and taking risk exposure as though all of it were exposed to macro risk or any risk whatsoever. How much do you just basically hide out in certain cash-rich companies, the magnificent 2 or 3 or whatever is left, and basically stay away from small caps, stay away from those that are interest rate sensitive, stay away from those that are vulnerable to all these risks?
So, look, this is a great question. And I do think that the mega cap trend, you know, again, not necessarily just 2 or 3 companies, but those companies that are exposed to these longer term secular trends like AI, like internet commerce, like cloud computing, they have further to go. So that is definitely part of it. And I also agree, you were talking before about real estate. One of the best ways to add value this year has been to avoid what I would call rate beta. In other words, those segments of the market, whether we're talking about low-income consumers and companies that are geared to their spending, commercial real estate, smaller regional banks, these are all parts of the market that generally going to be more sensitive to the fact that rates have actually grinded higher this year. And one of the things we've done is tried to minimize exposure to those segments. Generally, that's worked, and I think you continue to do it given this higher for longer environment.
There's an angst that's developing because people need something to worry about, people being myself, as everyone basically says the same thing in terms of crowding into the names that have been just throwing off bucket loads of cash and staying away from some of the more rate-sensitive sectors. It's a reason why we've seen the Russell 2000 underperform. At what point do you worry about crowding? And the sense that you can't avoid going into these stocks if you want to outperform, but that leaves the market that much more vulnerable to an idiosyncratic shock hinged to one of these companies.
Look, I think this is a real risk, and it's very hard to argue that there's not been crowding, but it's been interesting. You know, this is still a narrow market. It's still a market led by a handful of names, but you have seen some broadening out. Good example, utilities. Utilities is generally considered a low beta sector. It can be a very rate-sensitive sector, having a good year. Why is that? Well, of course, because for many investors, they're realizing that one of the constraints on the AI revolution is going to be electricity generation. And companies that are geared to that are geared to utilities, the grid, et cetera, many of them are having a great year. Now, this is something we didn't see 12 or 15 or 18 months ago, but I think it is an example of investors looking beyond 2, 3, 4, 5 companies and thinking about what are the other beneficiaries of this AI revolution.
Russ, I've got to ask, though, if that means the correlation between utilities and the biggest market weight on the S&P 500 goes up, what am I actually owning in the portfolio?
Well, you're still going to have a very big exposure to that mega trend. And that's going to be something, along with economic growth and rate beta, that you're really just going to have to decide how much of that exposure do you want. That said, you know, again, I think the reason that these trades have become crowded is that there are multi-year trends, and the companies that are geared to them, we know their names, are doing an amazing job of generating cash flow. And that's still a very desired commodity. And we think about what's working in this market, things like consistency, companies that can generate consistent revenue, consistent margins. And, you know, again, if you can stay long those themes, I think you're going to do all right.
Saw this line from Mike Wilson at Morgan Stanley yesterday. He said, bottom line, the data remains mixed, leaving all the major macro outcomes on the table. Russ, it's never easy. I always sit here and say that. What you guys do is never easy. It's always easy looking back. But what about this moment is more difficult than maybe other moments in the past?
Well, look, I think I actually would agree with some of the premise of what Mike is saying, which is that it's complicated. Generally, the economy is strong, or it's certainly in decent shape. We had more evidence of that last Friday with the May non-farm payroll report. But there are segments of the market that are under pressure. We've spoken about the lower-end consumer. They are feeling the pain of higher rates. Commercial real estate, the smaller banks. So I do think that generally, if you look at the economy, you've got strong growth. It's likely to moderate in the back half of the year. But you have to keep thinking about what are the segments of the market that are going to feel pressure, because we are in a higher for longer environment where the Fed clearly does not have the latitude of the desire to rush and cut rates.
Hey, Russ, great to get your thoughts. As always, buddy, Russ Kostrick there of BlackRock, breaking this equity market down. More broadly, the bond market as well, cross-asset. I'll share the fuller quote with you from Mike Wilson at Morgan Stanley. Bottom line, the data remains mixed, leaving all the macro major outcomes on the table for this year and supporting our recommendation for a barbell of quality growth and quality cyclicals with some defensive exposure. I think that's a highly sophisticated way of saying we don't know what the future holds. We don't know at all.
And he's not alone. I mean, a lot of people have been coming out with scenario analysis, with ranges of outcomes depending on what the inputs are. A lot of people are looking for that from the Fed themselves. What's your scenario analysis? How are you dealing with some of the input data rather than just saying, you know, we look at two things or we're data dependent? Choose your own adventure.
Yeah, this is frustrating for the Federal Reserve because we just sort of reduce all this down to their dot plot and the median dot for 24.
We work with what we're given.
Which is what we'll do tomorrow afternoon. Equity futures right now on the S&P negative by 0.25%. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. You guys mentioned this, that Elon Musk said he would ban Apple devices from his companies if OpenAI software is integrated into the iPhone maker's operating systems. He called it a, quote, unacceptable security violation. Apple announced yesterday that customers would have access to OpenAI's ChatGPT service through its Siri Assistant, with a new feature set to roll out later this year. Musk co-founded OpenAI, but had a falling out with the company, and he's currently working on his own competitor to ChatGPT. Golden Goose and its shareholders are seeking to raise about 558 million euros in the luxury sneaker brand's IPO. That gives them an implied market value of as much as 1.9 billion euros. Bloomberg had reported that Golden Goose was seeking a valuation at about 3 billion euros, a valuation which at the time the CEO told Manis and me on Bloomberg Brief that he was happy with. The main shipping channel into Baltimore's port has been fully reopened following the March collapse of the Francis Scott Key Bridge. It follows a massive cleaning operation with workers removing an estimated 50,000 tons of steel and concrete from the water. The wreckage left the port of Baltimore effectively closed for several weeks during that cleanup operation. Officials say they hope to rebuild the bridge by 2028. And that is your Bloomberg Brief. John.
Danny, thank you. What a fantastic effort. More from Danny in about 30 minutes' time. Up next on the program, Apple's AI let down.
Recent developments in generative intelligence and large language models offer powerful capabilities that provide the opportunity to take the experience of using Apple products to new heights.
That conversation just around the corner, live from New York City this morning. Good morning.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Wednesday, the Fed decides.
What data is important?
What would it take to reintroduce the rate cut
It's
conversation?
the labor market cracking that's going to allow the Fed to really enact some of its easing.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Inflation is still too high, and the path forward is uncertain.
They believe that policy is sufficiently restrictive.
The Fed can only deal with the data that it has.
Bloomberg surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Happy to confirm TK back around the table tomorrow afternoon for the Fed decision, a Bloomberg surveillance special kicking off at about 1:30 Eastern time. Don't miss it. As the two-day meeting kicks off down in Washington, D.C., equity futures pull back by 0.25% on the S&P 500. Yields lower by 3 basis points on a 10-year, 4.4315, and in foreign exchange, the euro, 107.45. Under surveillance this morning, Apple's AI let down.
Recent developments in generative intelligence and large language models offer powerful capabilities that provide the opportunity to take the experience of using Apple products to new heights. Introducing Apple Intelligence, the new personal intelligence system that makes your most personal products even more useful and delightful.
So here's the latest. Shares of Apple sliding after the company's long-awaited announcement on artificial intelligence. CEO Tim Cook saying ChatGPT will be coming to its operating system for iPhones and computers later this year. Elon Musk saying he will ban Apple devices from his companies if OpenAI is integrated, calling it a security risk. Dan Ives of Wedbush joins us now for more. So, Dan, let's separate the two stories. The complaint coming from Elon Musk and what was unveiled yesterday, and you were in Cupertino, California. So, Dan, tell me how impressed you were by yesterday's release.
I thought it was a historical moment for Apple because this is really now, as much as we talk about the generative AI from an enterprise perspective, the consumer AI story is going to go through Apple. This was significant. I believe this will be a catalyst to an AI-driven supercycle over the next 2 years.
Dan, we started the program by talking about Apple always being late but better. Can you tell me if this is late and better? It feels late. I just need to understand if it's better.
Yeah, I think Lisa was exactly right. It's late, but you have 2.2 billion iOS devices. So they could be late, but they have an install base that's unrivaled. And that's really what they're going after right now. It's going to be on the services side, the monetization. I think eventually will be a subscription service. And then this is something, if you don't have an iPhone 15 or later, you're not going to be able to access Apple Intelligence. And I think that is the key. The headline here is the long-awaited upgrade cycle that we've talked about a lot on the show is now in front of us.
So let's dig into that a little bit, Dan. If we don't see a material uptick in sales, say in September, November, December, and October, are you going to basically retrench some of your bullishness, or do you think it could come as late as next year and it still would be valid?
Yeah, if that doesn't happen, I'll come into the studio wearing a black sports jacket because I believe this is the start of a renaissance of growth. And I think what's important now is that Apple, really unveiling their AI strategy. Of course, Altman there, the OpenAI being significant. I mean, this is ultimately most consumers, 25% in the world, they will access AI through an Apple device.
Well, if we end up with sales as soon as next week, you'll be wearing the drapes. Dan, I'm curious about the idea of a subscription service. What are people going to be subscribing to, given the fact that right now you've got Apple Music, you have a number of other services? Are they going to subscribe to Apple Intelligence?
I think at first it's free, and that's the key for any Apple user. But this is essentially an AI brain in the iPhone. And where eventually this is going to go, developers that were all there yesterday that I saw, they're going to be building hundreds of apps based on this technology stack within the Apple ecosystem. And that's where more and more consumers are going to interact with it. This is just the start of now this AI party coming to Cupertino. But as much as it's late to the party, it's still 9 p.m. in this party that I believe goes to 4 or 5 a.m.
So, Dan, can you tell us why Elon Musk doesn't want to attend?
Because Musk, it's sour grapes. Because ultimately, this is what he wanted to do. From a Tesla perspective, obviously there's a beef with OpenAI going back, years. But this is essentially Apple in their castle saying, it's our data, it's our customers, you're not going to have access. But I believe Musk, this could be just some stress going to shareholder meeting this week. He's not going to ban iPhones, in my opinion.
In super simple terms, can you explain what his complaint actually is? What's he concerned about?
He's basically concerned about Apple and OpenAI having access to the data and no one else has access to it. And that what he speaks to would be a broader concern among other tech players, because Apple has a castle that no one else has. They have the devices. It's 1.5 billion iPhones worldwide, and they're saying it's mi casa, not tu casa.
So, Dan, you mentioned Musk and Tesla and some of the issues he's having. That stock, that name falls under your coverage. You're clearly very, very constructive on Apple. Where are you now on Tesla?
Look, I think they've gone through a Category 5 storm, but they're starting to turn the corner. And in terms of what we see later this week, I think that comp package does pass. That does remove an overhang. And then it's all about stabilization in China, FSD and autonomous going forward. But I think right now the risk reward is there positive. That's why the stock, I believe, is hanging in, even though they're going through some tough times from a demand perspective. Better days ahead, despite what's definitely a white knuckle period for Tesla shareholders.
That said, Dan, we talk about the AI supercycle, and that's the reason why Apple is sitting in its castle and creating a party that's going to go to 4 or 5 a.m. But there's a question for Tesla, where you have Elon Musk. You said sour grapes about not having this first. This is what he wanted. He wanted the castle, and reportedly diverting chips from NVIDIA, from Tesla, to some of his other efforts because he has no place to deploy them. Does that concern you at all in terms of Tesla's valuation as a technology company and not as just a car company?
Yeah, look, the AI initiatives have to be under Tesla. And I think when Musk made that threat, and this will come out at the shareholder meeting as well this week, 25% ownership, otherwise he takes AI out of Tesla. It does raise some concerns, but I believe at the end of the day, it's all going to be under the hood of the Tesla ecosystem. And look, Musk right now, it's a balance. But it's a pivotal time for Musk to prove that AI will be under Tesla. He recommits to being CEO, I believe the next 3 to 5 years. And I think then we have better days ahead. But right now, it's definitely been a turbulent period, and he doesn't help that.
Dan, on a bigger level, this is the first day of a 2-day Fed meeting, and a lot of people are wondering, how long can this continue? Where the AI early starters just basically accumulate all the cash and are the winners and accumulate all of the investments that we have from a lot of different investment managers, and they leave most people behind. How long can that divergence continue before something's got to give?
Look, I've been in the Valley now for 2 weeks. Seen 20 tech companies, all front and center in terms of the AI revolution. This is a 1995 moment, not a 1999 moment. And what I mean is the stronger and get stronger. And I don't see any slowdown, what we're seeing here, what we're seeing in terms of supply chain in Asia. And that's why I believe this is a tech bull market that continues to go forward for the next 18 months. But they'll be in the right lane, 45 miles an hour in the minivan, worrying about valuation. I just think right now this tech party It's going to be left lane, 100 miles an hour. I don't see it slowing down.
So, Dan, I've got literally 5 seconds. You're going to have to do this in a single word. I'm prehistoric, pre-iPhone 15. What's the one reason I'm upgrading? Just one word.
It's Apple Intelligence. Because I'm going to have it, you don't, and you're going to want it.
Trying to work out what the function is. Dan Ives of Wedbush. Dan, thank you, sir. More still to come on that. We'll catch up with Tom Forday a little bit later.
Join the party. Just get in there.
Just get in there.
It's
going to be like envy. It's
exactly.
Is that what it is?
It's
okay.
joy.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Coming into Tuesday, and all-time highs on the S&P 500 and the Nasdaq. Equity futures look a little something like this morning. We are negative by 0.25% on the S&P. On the Nasdaq, we're down 0.25%. Also on the Russell, negative by 0.75%. I mentioned Mike Wilson of Morgan Stanley a little bit earlier this morning. This is what he had to say later on the small caps. We view higher rates as a clear headwind to small caps, but we're skeptical that lower rates offer a comparable benefit. A key reason we remain overweight large caps.
And frankly, this has been borne out by the response in markets to any kind of move in yields. Basically, when yields go up, the Russell gets punished. When yields go down, the Russell hangs in and doesn't really gain that much. And that's basically what he's saying. At the same time, if you have the idea of lower yields and slower growth, those are going to be the companies that hurt the most.
Those stocks negative this morning. Let's turn the page to the bond market. 2-year, 10-year, 30-year looks a little something like this. We're down 4 basis points on a 2-year to 4.84 on a 10-year. Coming into today, yields were higher for 3 consecutive days. Now they're lower by 4 basis points at 4.4296. If you look at where we've been, Lisa, look at where the 10-year yield opened up 2 Mondays ago. We're below those levels right now, even with that big adjustment on Friday post-payrolls.
This sort of speaks to the point that Stephen Major was getting at, and the market is perhaps realizing the same thing. There is a downward trend, albeit fairly slow, when it comes to inflation going lower, disinflation. The idea that the pace of price gains are moderating. Question is how quickly. Question is what the response is going to be. This is a reason why Major is talking about that pivot point where people stop talking about inflation and start talking about growth. We've been talking about that pivot point for months now, and we haven't gotten it. I think that's what people are trying to sniff out, the reason why there's so much volatility in bond yields.
Yeah, we've said this a few times now. It felt like that last week, for the whole of last week, until Friday. Remember the ISM services came in better than expected. Everyone was focused on the subcomponents, on the employment component of ISM services. And you and I both said that feels like a stretch, but that's where the market was. Then it flipped back, just like that, at 8:31 on Friday.
How do you get an advantage in a market like this?
I think it's incredibly tough.
Which is the reason why you have people doing scenario analysis, do this, do that, whatever, but at the end of the day, buy NVIDIA. I mean, that's essentially all of the notes that I read. That is a subtext, and that's the reason why you saw the 26th record close for the S&P 500.
The 26th, you're still counting?
Yeah, 14th for the NASDAQ yesterday.
With the team here at Bloomberg. Good stuff. All right. We're going to keep counted as well. Just need to be a little bit higher again today. Let's turn the page. If it could get any harder, you just have to introduce sort of like European politics, and that's what we've got. The euro negative by 0.2%. Things haven't settled down in the French bond market. Yields were up by double-digit basis points yesterday. We're up by another 6 today. Spreads, France versus Germany, least at the wides of the year.
Yeah, and they widened the most yesterday in more than a year, just surging as people perceive the risk that, frankly, Emmanuel Macron introduced himself by calling a snap election. A lot of people saying, though, it's not as big of a risk as it seems. He has this mantra that he tells his staff, Emmanuel Macron, that, you know, you have to take risks, you need to be bold. But there was going to be a vote of no confidence that some of the far-right party were going to hold against him that would have probably neutered his ability to really do much for the remainder of this year. So this is trying to get ahead of that as well. There's been already a lot of turmoil, and this is sort of just crystallized by holding the snap election.
Don't you just love European politics?
I do, actually.
I know the runway in America is much, much longer, and it can be a bit crazy sometimes, but European politics, this came out of the UK this morning in The Sun, the newspaper. The candidates have been complaining that doorbell cameras have stopped people from answering the door to people trying to canvass them for their political party. So if you see a leaflet, you just don't open it. And what they're reporting is that one canvasser started carrying a parcel, a package, so that people thought they had a delivery, so that then they'd open the door and talk to them.
Oh my God, I feel bad for the canvassers, but
it's like
also
campaigning in 2024.
Hello, do people want those calls? No. Nobody wants to answer that door. If anyone answers that door, they will only stand there and listen to them out of social guilt.
Some people do, though. You know, there's 2 types of people. You know, the people that love that stuff.
Well, yeah.
Like open the door, like a good debate, an argument. Labour's here.
Full disclosure.
Sort of run out.
One of my family members, when they get a spam call, they try to really engage.
Oh, they engage?
Yeah, they're really interested, like over-interested, and see how long it can last. My response is, you guys have way too much time.
Well, like a scam where they're trying to get money out of them. They play along.
Oh, yeah. They ask lots of questions. They ask about the person.
Is that a family trait?
Let's move on.
Are you revealing something that you do as well?
No, I don't have time.
Okay. I've got no time for that either. Got time for that? All right. Out of surveillance this morning, Apple looking to catch up in AI. The iPhone maker announcing new integration with ChatGPT. The features called Apple Intelligence will roll out later this year, but more advanced tools won't come until next year. The stock was down by close to 2% yesterday, down another 0.25% this morning. Going through those features, we did this about 30 minutes ago. I'm just trying to work out what's going to get me to upgrade here. A revamped Siri that I don't use anyway, a partnership with OpenAI, maybe. They're going to summarize text, that might be useful. Create original images, zero interest in that whatsoever. Yeah, I don't care for that stuff.
You never did like Bitmoji and all that stuff?
No, I haven't used any AI tools to do anything like that at all in the last few months.
You probably have and you don't know it.
I'm just not the audience for this.
Okay, you're not the audience for this. I will say, Tim Cook used a word that I thought was really interesting and was actually a very Apple word, which is delightful. right? They're looking for people to play on their phones and use them as a tool that is addictive in that kind of delightful way beyond just sort of a personal assistant. So they have the personal assistant kind of aspects where things talk to each other, filling in your sentences. But some of the features, like being able to exchange money in this cool way that it sort of zips up, it looks like a sort of old fax machine or something that's going through your phone and then going into their phone, or some of the pictures, I could see how particularly a certain cohort that would be very exciting. And you're in a sort of social setting and there's a sort of peer pressure. It's like, why can't I get that?
Gotcha. But you said it earlier, it's packaging, not technological advancement,
100%.
right? Like, we already have that.
But isn't that what Apple does best? It is all packaging. Even the packages of their iPhones are kind of cool. Like, other things don't have them. They're brilliant at packaging. Can that get them over the hump? Well, Dan Ives thinks so. But, you know...
Sounds like you do too.
I actually know that it is bad to just outright be skeptical of some of these advancements because people go and they line up to spend thousands of dollars.
Oh, totally.
So I do understand that. On the flip side, I don't know if this is really what people were hoping for on a broader level when you talk about artificial intelligence. Is it a personalized Bitmoji? I don't know about that. I think that people were hoping for a little bit of a different kind of productivity boost than just more time on your phone.
The stock is a little bit softer this morning. More time on your phone, but maybe less time on Google and Google search, which is a conversation we'll have a little bit later this morning. Let's turn to this story. Secretary of State Antony Blinken looking to gain support for President Biden's peace plan between Israel and Hamas. Blinken saying Israel's Prime Minister Netanyahu is committed to the proposal after a meeting today. This marks Blinken's 8th trip to the region since the war broke out back in October. We know what Israel wants, release the hostages. We know what Hamas wants, which is some kind of post-war commitment from Israel that Israel right now is not willing to give.
The more that I learn about the situation, the more confused I get. The UN just passed a ceasefire resolution with 14 votes and 0 against, 1 abstention. U.S. voting for it, saying that Israel was on the same side, and now the question is over in Hamas. Very unclear what's going on. The details unclear. Benjamin Netanyahu has rebutted some of the assertions that the U.S. has said. Honestly, it is very difficult to get a handle on. Everyone's just hoping to get a resolution sooner.
Tough meeting for Blinken, that's for sure. The eighth visit, amazing. Let's turn to this final story. Mexico's President-elect Claudia Sheinbaum vowing to move ahead with reforms of the judiciary system. The announcement raising fears it will erode checks on the power of the ruling party. The peso making the strongest move in EM currencies as the US dollar heads for a 4th day of gains. Steve Englander of Standard Chartered joins us now for more. Steve, these are the worries that people have when it comes to EM. You worry about things like judicial reform. Steve, how important is politics going to be to emerging markets and more broadly to foreign exchange this year?
Well, it looks like it's getting increasingly important, in part because the market underestimated just how important and how big the shocks might be. You know, I mean, MEX is getting pounded in part because it was everybody's favorite trade a month ago. So, you know, if there were any long positions in the market, it was long MEX and short some low yielder. And those positions have been unwound. And if they haven't, they're getting unwound.
But Steve, how much does do some of these events, whether it's the election in Mexico, whether it's the election in India, whether it's the European Parliament, EU Parliament elections, how much does this just sort of underscores the preeminence of the dollar as a haven, despite some of the political dysfunction here in the United States?
Well, we have an election of our own coming up, but I'd say that the shocks that we've seen abroad kind of, you know, make the U.S. election look, you know, the differences look kind of relatively minor. I think that you know, it will come into play, I think, later on as perhaps the, you know, policy agenda of Trump and Biden become more clear and the divergences become clear, the implication of the elections become more clear. I know everyone sees that there's a colossal difference between them, but in terms of, you know, practical politics and practical policy, it's not exactly clear what one would do that the other wouldn't. I think that will become more clear as the election approaches. But, you know, we've had these massive shocks. You know, with the euro, I think everyone kind of went in kind of complacent, like European elections. That's like a headline that puts you to sleep. And, you know, all of a sudden you find the, you know, sort of the right wing sort of really picking up, and it has implications for what the EU can do as a bloc. It has implications for how the ECB has to respond. That has implications just because we don't understand how this is going to play out.
Unprepared. That is the word that I want to key in on, Steve. You're saying this just shows how unprepared markets were from some of these outcomes being more dramatic than expected, even though, quite frankly, a lot of these outcomes have been expected. Stephen, how unprepared is this market going forward to other potential political catalysts that could come down the pike at a time where we're coming off a pretty stagnant time, at least for some of the major currency pairs, and it has led to leverage and carry trades and all sorts of other things that could be unwound in the face of some sort of catalyst?
Look, I got to put on my nerdy hat. I think what happens, you have inflation that goes up a tenth, it goes down a tenth. You move the currency up or down a little bit. You have a political shock. It's like you go from one state of the world to the other. That's a much bigger shock. I mean, it doesn't happen that often, but when it happens, you have to sit back and say, wait a second, is this really kind of the marginal moves that we're seeing when CPI comes in 0.2 instead of 0.3, or is this like a big deal? And I think the market's, trying to digest whether this is a big deal.
Steve, that's the game we'll play tomorrow, the dot plot. If it comes down to 2 versus 1, how big a difference is there if the median dot shows 1 cut versus 2 for 2024?
Oh, I think it would be massive because, 1 cut runs down to 0. And, and I think that would lead the market to think that there's a real chance that the cutting agenda and all the talk about we're making progress, it just takes time, is off the table. And, we think that maybe there's a 1 in 3 chance that they do go down to 1. It's not going to be like everybody in favor of 2 and nobody in favor of 1. It's going to be very close. If the 1 does win, I think we'll see probably the dollar, break the year's highs. We'll probably see yields go up significantly, and markets looking at the these sort of reluctant cuts that so far are priced still into the end of the year. June and July are kind of out of the picture, but and kind of say, are these going to, what are the chances that these actually manifest themselves? We think the Fed will avoid that because there's no reason for them to throw that kind of message into the market right now. I don't think that they want to send that signal, but if they do, as our Fed piece, it's not going to be unintentional. It's not going to be an accident that they say, oh, we're at 1. The things happen.
Yeah, but Steve, can I jump in? How does that actually work on the committee? How do you get everyone to sort of coalesce around the idea, oh, I don't think we should go with 1? Do they look around the table and go, hey, Neil, can you bump that up a little bit? Can you go with 2 for this year? Just want to make sure the median comes in right. Steve, how do you do that?
Look, from what Fed Chair Powell has said, they don't do that. But, I think they're all aware kind of what the implications might be. And Powell has reiterated several times that they can change it up to, the morning, Wednesday morning, so that there's I think some of them kind of go out and say, look, is this the optics that we want? And you can find 1 or 2 to change it. It doesn't happen as a formal request, but it kind of happens organically.
Got it. Steve, thank you, sir. Steve Englander there of Standard Chartered. And whether we should be arguing about 5 basis points here and there, but ultimately the difference between 2 and 1 on the median dot tomorrow is, quote, massive.
Yeah, he says it's a major hawkish shock. He has it at something like a 30 to 40% probability at a time when potentially this could send a signal that they don't really want to send, according to Stephen Englander. So then do they take a straw poll and basically engage with peer pressure? Come on, just push it up just a little bit. A dot.
I keep using Neil's name, which is unfair.
It's okay.
I'm not saying he's susceptible to peer pressure.
He's actually probably the least susceptible.
Neil would be like,
pressure.
Excuse me,
yeah,
I'm sticking with 1.
He'd be like, what, just for that, I'm taking that
assuming his dot would be there. 1, who knows where his dot might be.
You can come on and tell us. Thanks, Neil.
We'll cover this tomorrow. That's going to be the show, basically, at about 2 p.m. when the decision drops, sort of going through the dot plot. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Bill Gross says that Europe is the place to look for opportunities. Gross said that to Bloomberg the day after 2 of Europe's most influential leaders, France's Emmanuel Macron and Germany's Olaf Scholz, suffered surprise defeats in the Sunday European parliamentary elections at the hands of the far right.
I think in terms of an attraction, German tenure Bunds and French Oats, the tenure there, Their spreads have narrowed significantly in the past month or two relative to treasuries, and today as well by 8 or 10 basis points. So there's coming a point where European bonds are more attractive than treasury bonds, in my opinion.
Gross went on to say that the recent market reactions to other elections from Mexico, India, and South Africa also offer a guide for how U.S. campaigns might impact assets in November. A New York City office building owned by a related affiliate is set to be sold at a steep discount. Empire Capital and Namdar agreed to purchase the property at 321 West 44th Street for less than $50 million, according to people familiar. That's a roughly 67% discount from its original 2018 price tag. Singapore Airlines has offered payment of $25,000 to passengers who sustained serious injuries during a flight that hit extreme turbulence last month. The payment would be address their immediate needs, the carrier said in a Facebook post on Tuesday. Singapore Air is also offering $10,000 to passengers who sustained minor injuries. One person died and several dozen of the 229 passengers and crew on board were severely hurt on the flight which departed London bound for Singapore. It was forced to make an emergency landing in Bangkok. And that is your Bloomberg Brief. John.
Shocking, absolutely shocking. Danny, thanks for that. More from Danny in about 30 minutes' time. Up next on the program, a losing game.
Trying to guesstimate that first move by the Fed, it's been a losing game. We tried, we missed. Others have tried, they've missed. The Fed's tried, it's missed.
I think we've all missed that conversation. Up next.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election?
It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Stocks negative this morning, pulling back from all-time highs on the S&P. Just a little bit softer, no real drama. Down 0.25%. Bond markets rallying, going against the grain of the previous 3 days. Yield to lower by 4 basis points. The 10-year 442.76. Under surveillance this morning, a losing game.
Trying to guesstimate that first move by the Fed, it's been a losing game. We tried, we missed. Others have tried, they've missed. The Fed's tried, it's missed. The Fed's not going to move Wednesday, that's no secret. Yeah, it might tweak the dots a little bit, big deal. But the bigger story is CPI. Does it really change the chance in a meaningful way the Fed really could cut this year?
Here's the latest. U.S. Treasuries rebounding ahead of tomorrow's doubleheader with U.S. CPI and the Fed on deck. Blorina Urucci of T. Rowe Price writing this. Given the resilience of the labour market, I think the risks are skewed in a hawkish direction. The dot plot could have only one cut this year. Blorina joins us now for more. Blorina, Steve Englander just moments ago said the difference between showing 2 cuts this year and 1 is massive. Do you agree with that?
I think the consensus view is that we're probably going to end up with two cuts in the dot plot, but that risks are skewed toward that one cut, and there's going to be the distribution will be interesting because it will show almost an evenly split FOMC between 1 and 2 cuts this year. So with that information in hand, I think the market has been able to absorb this. And I think at the end of the day, what's happening here is that the median in the FOMC, which I think, and most of the members, which I think includes Powell too, want to keep optionality about being able to cut interest rates as early as September. That's what that 2 dots is all about. And I think with that in mind, they'll let the data then increase or lower the probability of a cut in September. I think from my perspective, the direction of travel is that we keep pushing back that first cut, because the signal from the labor market is going to be that it's resilient, it's loosening. Labor market conditions are not as tight as they used to be, but the labor market is resilient. And then it's going to come down to how fast can you bring inflation to 2% for the Fed in this environment of strong demand and resilient labor markets. And we've figured out this year that that progress is likely to be slow.
Just to pick up on the labor market point, how conclusive is the view on the labor market data, particularly the data we just got on Friday?
I think what you're alluding to is maybe this mixed messages. We're looking at jolts, and that's where all the slack in the labor market has been created in recent quarters. The vacancy rate is down, quits are down, the churn in the labor market has slowed down significantly. You look at something like claims, the unemployment numbers are not increasing a lot. The unemployment rate has picked up slightly, but when you look at payroll growth, the rate of job creation in the economy remains pretty resilient. So a bit of mixed messages. What I'm reading from this mix of labor market data is that, yes, there is some slack being created because demand for workers is not as strong as it was in maybe 2 years ago. We also have more labor supply to fill those vacancies, partly because of the strong migration flows that we've seen in the last 2 years. But demand for workers has not collapsed. Also, we're not seeing firms lay off their workers, and this idea of labor market hoarding, because it was so hard to fill those vacancies post-pandemic. Many firms got burned, so they'll hold on to workers for longer than they would in other business cycles.
Lorena, it strikes me that people aren't sure of what's important and what's not to focus on. I mean, we heard Mike Schumacher saying that if the Fed kicks the dots down a couple, 1 by 1 dot, it's not a big deal. Then we heard Steve Englander say it's massive. It would be a huge hawkish shift. You have some people saying that the economic data has shown employment weakening. Other people saying, actually, there's a revival under the hood if you point to this and that and the other. What would you have to see to really materially change your view? Is there a data point or a data set that you are watching carefully to understand cracks that could really alter the landscape of just dramatic uncertainty?
What we've looked at in past business cycles is the labor market data. And by that, I mean, let's look at the weekly claims. Are we seeing signs here that workers are losing their jobs in large numbers? Let's look at the challenger job cuts. Are we seeing signs there of widespread layoffs? Back in late 2022, the tech sector was laying off workers, and maybe a few in the finance sectors, but it was not broadly based. So I think to start this recessionary cycle that people worry about, you need more broadly based layoffs, you need cracks in the labor market, and we have good forward-looking indicators and weekly data to monitor here. We're looking at company reports, we're looking at consumer spending. The data is giving, broadly speaking, I think, a message that conditions, fundamentals are still strong.
Are you concerned at all about a financial accident like Mark Zandi was talking about, given that the system is an engine that's just rattling with duct tape, kind of holding it together and patched up with Fed policy? That was his description.
We had our financial market shock with SVB. We did also a lot of balance about how opaque is private credit, private equity. It doesn't seem from looking at the data at a macro level that it's large enough to pose a systemic risk so far. And the Federal Reserve Board talks extensively about this in the Financial Stability Report that they publish every quarter. So there's always reasons for concern, and I think vigilance is important. I'm not losing sleep over that right now.
Lorena, appreciate your time as always. Lorena Urucci there of T. Rowe Price going into the Fed decision tomorrow. Mentioned Steve's work a few times, caught up with Steve Englander of Standard Chartered just moments ago. Many in the market would see a single cut as backing away from the policy rates of peaked view, opening the door to serious discussion of the possibility of further policy rate hikes. Would that really bring that back on the table tomorrow afternoon?
It takes so little to get people talking about anything, because that's how sort of uncertain everybody has become. So I could see how that could happen.
In the second hour on Bloomberg Surveillance, we'll catch up with Omar Aguilar of Schwab Asset Management, Aaron David Miller of the Carnegie Endowment for International Peace, Tom Forday of Maxim Group on Apple's new AI, and Ian Steely of JP Morgan Asset Management.
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group, where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
it's not obvious to us that there's urgency for the Fed to ease.
I think they'll continue to stay their data dependent and that the data is murky.
Trying to guesstimate that first move by the Fed, it's been a losing game. We tried, we missed. Others have tried, they've missed. The Fed's tried, it's missed.
Obviously, the market's going to take any cut as a start of an easing cycle.
I don't think the market really cares whether we're going to get 1, 2, or 3 this year, as long as the next move is down.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, where we will play a losing game. Okay? You ready? I mean, that's what we're going to do.
Sounds like a lot of fun.
Yes. So Ben Lader of eToro says this: I don't think the market cares if it's 1, 2, or 3 cuts this year. Okay? Steve Englander of Standard Chartered comes on 10 minutes ago, and we ask him what's the difference between signaling 1 or 2, and he says massive.
Yeah.
So basically, this is the next 24 hours. Some people say it won't matter. Other people say it's a big deal.
You know, I'm glad you began with this because it goes to the heart of how people can understand what's going to happen in terms of the data, but really not understand the market reaction. We've gotten a couple of different catalysts, whether it was the French election, or whether it was the EU parliamentary elections, or whether it was some of these data points that were largely expected, where nobody could really understand what exactly the market response would be. You have JP Morgan strategists coming out overnight and saying that either way, if there is an upside or downside surprise in CPI, it could be a pretty massive move in equities, and it could be undone by the Fed just hours later.
The word I keep hearing is optionality, not just at the Federal Reserve, but also at the ECB. They want the optionality, they want the flexibility in the incoming meetings to do whatever they need to do. I see that in the work from Goldman, too. We think the leadership would prefer a 2-cut baseline to retain flexibility. I'm not sure how you get the FOMC to sit around the table and put in their individual projections to try and come up with this beautiful, perfect 2 median dot showing 2 cuts for 2024. Maybe that's how things turn out, but can you construct that sitting around the table? I'm not so sure.
It sounds much more top-down than the actual cat herding that it actually is, at least from descriptions of people who have been on the committee. Question is, going forward, how much of that 2-cut baseline to preserve maximum optionality is in part representative of the schedule, right? I mean, if they put 2 cuts and if the data softens considerably and they cut in July or September, they are less exposed to political accusations if they already have 2 cuts penciled into their baseline in terms of their dot. So in terms of optionality, that could be part of what's behind that.
2 makes more sense than 1. You have the space to reduce it from 2 to 1 later this year if you need to. September's still a curious one for me. I know a lot of people might point to the fact that we did, I think, QE3 back in September, was it 2012, September 2012? I know lots of people point to that date as just an example that you can do big things going into an election in November. They know the spotlight's on them big time in a way that maybe it hasn't been before.
The bar has gotten higher in terms of their justification for cutting, especially at a time where this is a peripheral data point, but this morning we got small business optimism, and it came in stronger than expected. Again, this is not showing signs of a dramatic weakening in an economy that is shown to be a bright spot in the global economy. So you raise this question, what are we missing? Can you discount everything and just cherry pick the data that shows weakness for long enough to get you justified rate cuts, or are they looking for something else?
Yes. I think yes, and you knew that was the answer to that,
well,
too.
I mean, it's a losing game.
Yes, that too. Equity futures on the S&P, your scores look like this, pulling back by 1/3 of 1% on the S&P. Record high close yesterday on the S&P 500 and on the NASDAQ too. This from the team over at Bank of America. No landing is back in debate. That's not bearish. Lisa, I'm sure you saw the same thing.
Yeah, I mean, this idea that no landing is actually a positive going forward at a time where we could just sort of grind out some kind of growth. Again, I actually do think that one of the bigger fears is kind of percolating to the surface as longer this goes on, how much crowding in a number of the winners really just continues, considering that there isn't anything to shake that.
Yeah, the conclusion's the same for all of these conversations.
All of them.
You said it, it's NVIDIA, like consistently.
I mean, what's there to not like? And frankly, the other consistent theme that I'm seeing in all of the different notes is we could see a pullback in the next couple of months. There could be some sort of volatility, but buy the dip. We've heard this repeatedly, and so there has been no dip.
It's the ultimate barbell. It's like T-bills on one side and NVIDIA on the other. Coming up this hour, Omar Aguilar of Schwab ahead of tomorrow's CPI and Fed doubleheader. Tom Forte of Maxim on why Apple's new iPhone could create problems for its customers. And Ian Steely of JP Morgan Asset Management as politics shakes up European bonds. We begin with our top story. Stocks heading steady ahead of tomorrow's big event. Omar Aguilar of Schwab writing this. We expect a slowdown in consumption and hence expect growth and inflation to subside in the second half of 24, opening the door to Fed easing. Omar's with us around the table for more. Omar, good morning to you.
Good morning.
What kind of Fed easing are you and the team expecting this year, and how big a difference is there between 1 and 2?
Well, I think in all these specters, always, what the Fed thinks and also what the market thinks. And it's just a matter of, how this gap, works together. I think the market seems to be pricing in 2. And we believe that, the data will show that at least there's going to be 1. The question is going to be September or December. And I think September is the bigger question mark. And a lot of that will be a function of 2 things. One is going to be unemployment, and the other one is going to be inflation. So I think the 2 are competing with each other. On one hand, we see that trends in inflation are exactly where the Fed wants it to be. I think we're probably going to see some of that data tomorrow, where the trends continue to point towards that lagged effects going to deflationary that allows them to have that, flexibility they seek. And that will actually put them, in the right path for having 2 potential options. The question becomes, whether or not, the economy is going to be stronger than what they expect, and therefore potentially, have them under 1 camp.
This is complicated matters for a lot of people who have come on this program for a few reasons. Here's one. So bond managers and bond strategists have been joining Lisa, Anne-Marie, and me for a number of months ago now, making the argument that they need to get out of cash, go out along the curve, because the yields available now won't be there in 6, 12 months because the Fed's going to start cutting interest rates. All heard the argument. Maybe it's intuitive, makes a lot of sense. How successful have you been getting clients out of low-fee paying money market funds and getting them out of cash and doing other things?
Not very successful yet. I think, the time lags of getting people to deploy cash has just begun. I think, we're starting to see, we saw that at the end of the tax season, this is April, where you actually see movement in money market funds, mostly just because of taxes. But we're starting to see that people are starting to look for opportunities to deploy that cash. Now, the big question becomes, do you hold on for the next 6 months until you get that, increasing your reinvestment risk, which is the, key point that you just made, which, in many cases, clients are actually willing to hold on for at least the next 3 months to be able to start increasing duration. And the bigger question becomes whether or not that comes with credit or without credit. So credit exposure relative to what they want to have, we don't believe that is necessary at the moment. They can still increase duration, enjoy higher yields, go into intermediates, but still stay in the high quality part of the market without necessarily having to extend, credit, so that you don't necessarily have that, asymmetric risk that, credit brings.
I kind of understand why people would want to just clip a 5.25%, 5.5% coupon for the foreseeable future, especially without a clear path to, fiscal responsibility or a potential lack of volatility. And with another $39 billion of 10-year treasuries being sold today at 1 p.m., there's another auction. It's my plug. But, all of these kinds of issues give people a real level of concern. How do you sort of make the argument that it's a valid trade to be made at a time where it doesn't seem like the economy is falling off a cliff, and it doesn't seem like long-term inflation expectations are going down that dramatically?
Well, I think at the end, it becomes about, what is the opportunity cost of staying in, invested at 5.25. And I think if you believe that the risk premium continues to stay in areas that actually becomes attractive, as you see real rates starting to increase when inflation coming down and the Fed doesn't moving, really the opportunity cost on investing in cash, gets, a little more difficult to sustain. The second thing, which is what we were saying before, is reinvestment risk. There is no question that with 1 or 2 or even more rate cuts in the next couple of years, as markets becomes more normal, the ability for reinvesting at 5.25 on the short part of the curve is not going to be available.
Reinvestment risk is an interesting idea, especially at a time where it seems like the biggest risk is not being in NVIDIA. I mean, essentially everybody comes on and they say, our equity exposure and our credit exposure, NVIDIA, and then cash. I mean, that sort of seems like the, takeaway that I get from a lot of people who have very complicated macroeconomic frameworks, and then it comes down to NVIDIA and clip your coupons. I mean,
What's your argument against that versus really betting on any of these macroeconomic trends that have just seemed like a black box?
Well, it all comes down to what is your sense of, investing and the duration of your investments. On one hand, investing in equities, particularly any part of the equity market, you obviously have a long-term view of what you think you're doing with those earnings projections. And if you believe that any of the top, 7 names in the index is going to continue with the level of earnings power that they have, that's a long-term investment you have. You're putting a long duration, bet on it. On the other hand, you're basically looking at the curve on fixed income, which is a short-term, piece, and it's blending the two. What basically matters. And as I said earlier, it only matters when you actually think that there's a risk premium that you actually want to take advantage of.
Omar, as you know, pre-pandemic, people gave up on bonds for income. A whole generation of people. There was no income there. There was no yield, particularly over in Europe. Have we reset things? Have you seen attitudes change and reset over the last few years?
I would probably say it's not the last few years. I think it's been the last 6 months where people started to realize that there's a great set of opportunities to be in fixed income that we probably didn't have for 15 years. And, parts of the part is like now you actually have a total return in fixed income that becomes attractive, relative to, what we used to have pre-pandemic.
So PIMCO might be talking his book here, but they were on the program just last week. I'm sure you saw them making the argument, the new 60-40. This time it's 60 bonds and 40 equity. What do you make of things like that we've had this sort of generational reset of yields, that the compelling case going forward from here is really quite good?
Well, I think, the different parts of the risk premium that you actually have will still suggest that it's still 60% equities, 40% fixed income. It's very difficult to actually change that makeup for that level of risk profile, especially given the next 5 years, where we're probably gonna see these real rates that stay in that 1.5 to 2%. So when you actually think about that, and you think about the notion that we're gonna go to probably a more normal times, and that's maybe a little bit of part of the process, where the economy is gonna grow at a normal pace, where we're going to see, business cycles are going to be a little more normal. We're going to have less of an impact of the big pandemic we have, or the big financial crisis we have back in 2008. Now we're basically going to this setup where there is enough investing opportunities that includes fixed income, that includes cash, and that includes international, that for the longest time has not even been a possibility, because the U.S. has basically performed much better than any international markets.
We've heard from a lot of people that in the past 6 months, you have seen, actually the past couple of months, you've seen a real swing in sentiment by investors to a more FOMO kind of bullish tilt. Is that what you're finding, that they're looking to take more risks, that they're more open to some of those sort of reinvestment concerns and not just sort of staying harbored in the mattress?
In general, yes. The optimism regarding, investing continues to just, grow. A lot of that is availability of information. A lot of that is ability, for people to open accounts. A lot of this, has to do with that. It is interesting because generations change. When you see Generation X and baby boomers continue to be incredibly invested, and they love to just be in the market, the younger generations is still going into the process, but they are starting to invest early. So they're not as bullish and as optimism as the older generation, but at the same time, they ended up starting investing earlier in their lives.
Omar, this was great. It's going to get an update from you as we still wait for those people to sort of get out of cash and get out along the curve, right? Waiting for those cuts.
I mean, this idea of what reinvestment risk, and I think Omar put it well, which is until they can understand that there actually is a reinvestment risk, what's the problem? And right now, there isn't much for about $6 trillion of assets.
More debt coming a little bit later. Lisa might have mentioned 10-year. How much?
It's $39 billion.
Sort of snuck that into that conversation, yeah.
Oh, you noticed.
I just supply.
Come on.
Coming later on.
Yesterday was interesting.
Yeah.
The auction was actually compelling. Today it will be too.
Do you want to tell us why?
Yeah, because it was soft, and it was a 3-year auction, and it tailed, and it really had a pretty negative takedown. It basically had one of the lowest non-dealer take-ups in a while, and it was, it shows a certain degree of skepticism.
We'll see if the 10-year is equally as entertaining a little bit later. More buybacks for you too. This from General Motors, the board approving a new $6 billion share buyback. GM saying they're growing and improving profitability of the EV business. The CFO saying they're very focused on profitability of the internal combustion engine business as well. GM, Lisa, up by 0.9%.
They've been playing catch up actually in a pretty big way, especially after a lot of people valued them just as a car company and one that was almost left for dead for a while. They've got some catch up to do at the same time that Tesla's been, how much has it lost this year? Some 30%?
Yeah, something like that. I'll bring you the actual number in a moment when I can get it up on the screen quick enough. Just getting this next headline from GM that reports second quarter final results on July 23. That's the latest from General Motors this morning. More on that a little bit later. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Donald Trump will meet with Senate Republicans on Thursday in an effort to plot out his priorities if he wins a second term in office. Senate Republicans hope to win a majority in November, which would give them the power to push Trump's legislative priorities and cabinet picks. Trump has a busy schedule. He'll also be participating in a meeting with CEOs hosted by the Business Roundtable. Former Archegos boss Bill Hwang faced blistering testimony in court on Monday. Hwang's former top trader told a jury that he was told to do the opposite of what a normal fund would do, including committing financial crimes, manipulating markets, and lying to banks. He went on to say that Hwang told his traders to maximize the effect on share prices at all costs. Hwang and his co-defendant have pled not guilty and are in the 5th week of testimony against them in their trial in Lower Manhattan. PIMCO says that more regional bank failures are on their way. John Murray, the head of global CRE, said the real wave of distress is just starting and that lenders still have a very high concentration of troubled commercial real estate loans on their books. Murray also pointed to U.S. debt funds, where more than $200 billion of loans are set to mature through 2025, which he says will struggle to refinance with higher rates. And that's your brief, John.
Danny, thank you. And just getting that confirmation, negative 30.06% to be precise.
Thank you. I appreciate the clarification.
Anytime. You knew that already.
Well, you know.
Up next on the program, the U.S. waiting on one vote.
I met with Prime Minister Netanyahu last night, and he reaffirmed his commitment to the proposal. Everyone's vote is in, except for one vote, and that's Hamas. And that's what we wait for.
And that's the conversation we'll have next, live from New York City this morning. Good morning. Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Decides.
What data is important?
What would it take to reintroduce the rate cut conversation?
It's the labor market cracking that's going to allow the Fed to really enact some of its easing.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Inflation is still too high, and the path forward is uncertain.
They believe that policy is sufficiently restrictive.
The Fed can only deal with the data that it has.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
This just in, I've got to share it with you. It's one of my favorite statistics that comes out of Bank of America and the Bank of America Institute, led by Liz Everett. The stats on bank balances and savings, the data that they have, So this month they looked at bonuses by household through the lens of age cohorts. Listen to this, Bramo. Every age group is up at least 44% since pre-pandemic levels. Big outlier. Gen Z, up more than 137% of pre-pandemic levels.
Well, yeah, in part because it was a low bar. They probably were, a lot right out of college. But even still, those were the jobs that saw the biggest wage gains. And we saw that during the pandemic. And, maybe that will be the reason why they're the entrance into the new market, which is what Omar was just saying.
Yeah, it's pretty amazing. Savings and checking balances for all age cohorts. Every age group up at least 44% since pre-pandemic levels. More on that a little bit later. Equity futures right now slightly negative. We're down by 0.4% on the S&P. We're down by 3 basis points on a 10-year, 443.55. Under surveillance this morning, the U.S. waiting on one vote.
All of the hostages, but especially our 8 American families who have loved ones in Gaza, we are determined to bring them home. The proposal that President Biden put forward is the best way to do that. I met with Prime Minister Netanyahu last night, and he reaffirmed his commitment to the proposal. Everyone's vote is in, except for one vote, and that's Hamas. And that's what we wait for.
So here's the latest. International pressure growing on Israel and Hamas after the UN Security Council unanimously passed a 3-phase US-backed ceasefire plan for the Gaza Strip. The plan calling for the release of all hostages in exchange for Palestinian prisoners in Israel, the return of displaced Gazans, and the withdrawal of IDF troops from Gaza. Joining us now to discuss is Aaron David Miller of the Carnegie Institute for Peace. Aaron, in some ways, Secretary Blinken makes it sound quite straightforward. We wait for one vote, that's Hamas, and that's the vote we wait for. How do you see things?
Traditionally, Middle East negotiations have only 2 speeds, slow and slower. And this is not a normal traditional negotiation. The principal Palestinian decision maker is ensconced in a tunnel somewhere below Khan Yunis or Rafah, or maybe even in a tunnel in Egypt across the border. And you have indirect negotiations going on with the Qataris and the Egyptians, each with their own motives. And then, of course, you have Israeli politics. So I think the sequence is clear, but we'll see where it goes. Hamas is either going to produce a clean yes, unlikely, a yes, but that's reasonable. That may force the Israelis and the Americans to do additional negotiation, or a no. And a no, of course, would make it much easier for the Prime Minister of Israel, who I think really is not interested in a complete implementation of the president's proposal, to basically continue to maneuver, buy time, and watch this thing play out.
Aaron, to that point, let's say the answer is yes. Do you think that Benjamin Netanyahu would go through with it?
I mean, he's going to have to present, if it's a clean yes, and it's hard to believe in any negotiation, a clean yes, but let's say assuming Hamas says yes, then it's going to have to, it's already been endorsed by the War Cabinet, which may or may not exist now since Benny Gantz has left. It'll go to the full Israeli government, and the 2 most extremist parties basically have said, we will not accept any part of this proposal. So if in fact it's presented to the government and they say no, then there are 2 possibilities. Either Yair Lapid, who's already publicly said he would give Netanyahu a safety net to go forward, and you'd have a sort of disunity government for the next several months, or alternatively, the government falls, presumably, and you'd end up with new elections in 3 months.
On a broader level, Aaron, you've been covering the Middle East for decades. You've been watching events transpire. It strikes me that this is a particularly intractable situation, and one that has sort of changed the social fiber and the political dynamic in ways that we really haven't seen before. How do you understand how the conversation has changed, not in terms of in the Middle East, but also in the United States around this issue?
Look, I think you've got a situation, in decades of working in the State Department and following this issue, never have I seen any Middle Eastern issue provoke the kind of controversy and domestic turmoil that this one has. And I think in an election, which could be contested by 3 states and under 100,000 votes, any impact, any event, including Gaza, the uncommitted, those who won't vote for the current president, or won't vote at all, could have an impact. I think the domestic climate here politically is also very fraught. You have a Republican Party that has emerged as the Israel can do no wrong party, and you have a Democratic Party that's deeply divided on what kind of Israel mainstream Democrats and progressive Democrats are prepared to support. And against the backdrop of all of this, of course, you have the Prime Minister of Israel, highly controversial, due to address a joint session on July 24, besting Churchill's record of 3 addresses to a joint meeting or a joint session of Congress. So it's become a political issue, a fraught one in a way I think it's never had this sort of impact before.
Aaron, there's been a lot of focus, certainly on a number of big companies, on the role that a lot of universities have had in this. We don't have a lot of time, but in a minute, can you give us a sense of whether you continue to expect universities to sort of produce some of the protests that we've seen recently?
I mean, it's really hard to know. These protests came out in May toward the end of semesters. Will they have the sort of impact in residents again in September? It's really tough to say. But again, I think you've got a situation where the Israeli-Palestinian conflict has basically created an opening for any number of laments, complaints, and ideologies. And I think that's, frankly, quite dangerous, because the way this conflict is not a morality play between the forces of goodness on one end and the forces of darkness on the other. It's a very complicated conflict in which both sides have competing needs and requirements that need to be met. It's really Goethe's definition of a tragedy, I think. 2 competing justices. I only wish that the political dialogue in the United States could reflect that sort of pragmatism and balance, because maybe we could create the kind of political consensus that would help, at least on our side, resolve this rather than exacerbate it.
Well, we appreciate this dialogue this morning. Thank you, sir. Aaron David Miller there, the Carnegie Endowment for International Peace. More still to come from New York. This is Bloomberg.
This is Bloomberg. Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equity futures on the S&P 500 negative here by a third of 1%. On the Nasdaq, we're down a third of 1%. Also on the Russell, the small caps underperforming. Seen this quite a few times. We're down by 0.75% on the Russell this morning. In the bond market, 2-year, 10-year, 30-year, here are the scores, and then I'll get you some commentary. On a 2-year, we're down about 4 basis points, 484.25. On 10s, we're down 3 after climbing for 3 consecutive days coming into Tuesday. We're getting back to about 443.94 on a 10-year. This from Andrew Holdenhorst of Citi. Dovish risk going in tomorrow. That is not what we've heard at all from the consensus. Andrew saying Powell may lean dovish. 272,000 new jobs, an upward revision from 2.6% to 2.9%. Q4 core PCE inflation present what could be seen as a hawkish backdrop for this week's FOMC meeting. Team goes on to say, but a rising unemployment rate, falling job openings and slowing inflation, including what they project to be 0.26% month-over-month core tomorrow morning, mean we see more dovish risk at tomorrow's FOMC meeting.
2 comments. Number one, probably a fair guess considering that Jay Powell has gone dove pretty frequently. It's sort of a normalcy that we see the statement and it sounds fairly balanced. And then Jay Powell comes out and he basically is like, no, we want to cut, and everybody rallies. So that's fair. On the flip side, there also is this point that Andrew Holdenhorst and the team did push that cut back to September from July. But their base case has not changed. They still do think there is going to be really significant weakening in the labor market. We just haven't seen it yet.
Well, depending where you look, you know, because parts of Friday we have seen it. Other parts we really haven't.
It's so frustrating. I got to say this, and I like this idea of narrative fallacy, where everyone's trying to create some sort of bigger story around each individual data point. That's the reason why we're all running around like chickens with our heads cut off.
Well, let's keep running around like chickens with our heads cut off, which is kind of like this show at the moment. Let's turn the page and take a look at what's happening in European markets. So the euro's weaker again by a third of 1%. French equities are down another 1.2%. Bond yields are higher now by another 9 basis points. I think the takeaway for me this morning, just waking up, just having a sneak peek of what was developing in Europe a little bit earlier this morning. Lisa, this hasn't settled down from yesterday in France. It really hasn't. The trend has continued.
And why? Because we weren't surprised by the outcome of the European elections, right? A lot of people had been expecting this. Sure, there was a little bit more of a tilt to the right, but otherwise it was pretty much in line with the polls. There is a realization that politics matters. And as much as people don't want to think about it because it's something that is totally uncontrollable and unpredictable, it is something with profound implications. And they're seeing that across the Euro region. What I find interesting is that both Italian bond yields as well as French bond yields are surging relative to German bond yields. Why? Given the fact that Germany is seeing the same kind of wave, if not more so. So it's sort of, you know, there are a lot of questions embedded in this data about what the knee-jerk response is to just this feeling of uncertainty.
Yeah, I think consensus view of the people that come on this show, I think they've wanted to ignore the politics this year. More specifically, they've wanted to ignore what's developing in November this year. I just wonder how close we are now. You were putting your hand up because you were one of them, right?
Exactly.
Yeah, I just wonder how close we are now to actually just saying, I don't think you can ignore it anymore the deeper we get into summer. And I would say the starting gun for that, for me at least, is the end of this month, the debates start, and then it's just impossible to ignore.
But the issue is people aren't ignoring it, they're talking about it, but what do you do with it? I mean, this is really the challenge. How do you hedge? And so that's why you are seeing more hedging. We can get a number of people on to talk about that. Amy Silverman's talked about how there is sort of a gapping out in some of the options trading to highlight that nervousness. I just wonder, how do you prepare? Well, how do you even understand what the market reaction is to potential policies and what the candidates will say or do between now and then?
You know what the conclusion is, T-bills and
NVIDIA.
Yeah, there you go.
That's what you
All
do.
right, it's like the conclusion to everything at the moment. Under surveillance this morning, investors looking ahead to tomorrow's doubleheader. We'll get CPI at 8:30 Eastern Time, followed by a Fed decision at 2 p.m. Investors widely expecting, also looking towards the so-called dot plot for clues on the Fed's path forward. Elsewhere, crude holding steady after posting its biggest single-day jump since March. OPEC releasing its monthly report, expecting strengthening oil demand in the second half, the same time frame that it plans to hike supply. Crude a little bit lower again this morning by 0.2%. And finally, Apple's big AI reveal leaving a sour taste in the mouth of some. The company announcing ChatGPT is coming to its devices later this year. Elon Musk responding, saying he'll ban Apple devices from his companies if the OpenAI software is integrated into the iPhone maker's operating system. Tom Forte of Maxim Group writing this: consumers feel like they have new phones when Apple updates its mobile operating system. To the extent it rolls out its AI-related efforts in a way that breaks that bond with consumers, that could result in backlash for the company. Tom joins us now for more. Tom, I just want to start with that point. In what way would that break its bond with consumers? What's your view on that?
There's two real risks to Apple's brand on Apple Intelligence. One is what I wrote there, which is when you buy an iPhone, you get that new iPhone feeling every fall when they roll out the new mobile operating system. So if Apple's saying, you know, this Apple Intelligence is really cool, which remains to be seen if it is, but you need to have an iPhone 15 Pro because the chip on your iPhone 15 is not adequate to do it, then you do not get that new iPhone feeling every time they upgrade the software. And I think they're breaking a bond with the consumer. The other risk to brand is that they've named it Apple Intelligence. So if we use Siri as a guide, Siri's kind of been a failure to the extent that my own anecdotal use of Siri is a glorified egg timer. So to the extent that now I'm going to rely on Apple Intelligence and Siri for all this supposedly wonderful artificial intelligence, I think there's a lot of brand risk for Apple in the move here.
Tom, this is interesting because we caught up with Dan Ives, and I wish we'd formed a panel with you both a little bit earlier this morning. Dan Ives of Wedbush earlier today was saying, this is it. This is going to be the thing that unlocks that elusive upgrading cycle, that mega upgrading cycle we've been looking for years now. Dan says it's just around the corner based on what they released yesterday. Why is he wrong?
He's wrong because I think that artificial intelligence is not ready for prime time. When you think about hallucinations, you think about the many issues that Google's had with Bard, and then now integrating with ChatGPT. Consumers are going to get a lot of bad information. It may not be have a rock every day or, you know, include the glue when you make the pizza to keep the cheese to stick, things of that nature, and it may be. So I think that I understand why Dan thinks this could be the elusive upgrade cycle, the first major upgrade cycle since 5G, but I'm not convinced that we're there yet.
Tom, just to put a bow on this, basically we heard from Dan Ives that he will wear a black suit if they don't get the kind of increase in sales. Will you wear Dan Ives' wardrobe if they do see that increase in sales come September?
I will wear his most obnoxious, boldest colored outfit. We could go Knicks, blue and orange, even though I'm a Bulls fan. Absolutely.
All right, we will be there for that. I will wonder, just going forward, you said something that I found really compelling, that this is breaking a bond with the consumer. There has been a feeling that if you had an Apple phone, if you had an iPhone, you would be a subject of whatever kind of new advancements were coming out for the phone specifically. You think that this is actually going to cause people to turn away from the iPhone, is that correct? Or else just keep their old ones?
I think there's real risk here that the consumer will be less enthralled to continue to buy smartphones from Apple if they don't get that new phone feeling every fall when they upgrade the software. So yeah, I think that's a real issue.
Where do they go? And I guess this is why we saw Samsung kind of trolling Apple yesterday, putting this out. Adding Apple doesn't make it new or groundbreaking. Welcome to AI, followed by an Apple emoji. This was Samsung's official account, putting that out there on social media. Do you think that Samsung wins out here if they introduce something that's more polished, more advanced, and frankly diverges more significantly from what's currently available?
Well, I think Samsung could win out to the extent that a consumer dissatisfied with the Apple experience, either because of Siri or Apple Intelligence or things of that nature, may gravitate to Samsung. So yes, but at the same time, I think that the AI issues are kind of industry-wide. There's hallucinating on Samsung phones as well. But yeah, I think you might see some switching here if this bond is in fact broken.
Hey, Tom, this relationship with Google is interesting. You're one of the few that's really, really digging deep and talking about it. I assume we'll be spending lots of time doing other things and less time on Google search. And I'm trying to work out if that's sort of good for Apple and bad for Google, or bad for both.
I do think that bad for Google is a fair interpretation of yesterday's news to the extent that they're integrating ChatGPT, although they did open it to other large language models, including Gemini from Google. But yeah, I think that the challenge for Google in search is to the extent that Microsoft integrates OpenAI's technology, and to the extent that consumers lean into artificial intelligence to advance search despite the challenges, that could be a real issue for Google.
Not just Google. There was an issue for a lot of apps and app creators that came out. I'm thinking of Grammarly. I'm thinking of some others. There was sort of a list of RIP, all of these different apps yesterday trending, as people took a look at what would be rendered obsolete by some of this technology. Do you think there's going to be a real tension, particularly with Apple's dominance in the App Store, between some of these app providers and, frankly, the fact that they've been rendered obsolete overnight?
Absolutely. The number, though, that stood out to me yesterday is that there's only 2,000 native apps for the Vision Pro. So that feels like a low number 1 year into the product. And it reminded me on larger scale of the flashlight app. So there was a point in time where if you wanted to use your iPhone as a flashlight, you had to get a dedicated app. Now it's a feature within iPhone. So yeah, I think there's a lot of risk of irritating the developers here as well.
Tom, just finally, we'd love your view, just to finish up. Want to hear a little bit more from you on Elon Musk and that complaint from Elon. What did you actually make of that? Do you actually think he'll follow through with that?
I do. And so I admit, though, I'm only halfway through Isaacson's book on Elon, which I'm enjoying immensely. But I do think that Elon, while he may crave drama, I think there's a lot of validity into his comments. And I worry about the consumer who flip-flops between Apple Intelligence and ChatGPT, one that's supposedly privacy protected and the one that's open and doesn't know better. So I think there's going to be a lot of fun stories. The good news is now we have Apple strategy. Now we get to see how it works out.
Interesting. Tom, looking forward to the results. Tom Forte there of Maxim Group. Someone's going to wear the suit they don't want to wear, right?
Oh, I can't wait for this.
It's
I'm actually,
Dan Ives in a black skinny tie and a black suit, or it's Tom.
He didn't say skinny tie.
Orange and blue.
Are you going to supply?
I'm dressing him.
You're going to be his sartorial.
He knows this.
Consultant. Yeah. You're going to basically give him something, and he's going to come out here with like this feeling of shame.
Something like that. You're on the money, though, by the way. What this makes obsolete. It's going to be very interesting how quickly that happens, too.
Well, at a time when you hear Washington, D.C. dialing up the pressure on Apple and kind of how dominant it is to either make or break so many different innovative upstart companies, right? There's going to be more discussion about that. And we heard that just now from Tom Forte, this idea of the flashlight app. I mean, I don't even remember that time period because I just, press. Who doesn't use their phone as a flashlight?
The flashlight comes on accident all the time.
I know. But
when did you put that light on deliberately? Come on.
Yes, I always put it on deliberately.
Comes on, do you? What for?
Yeah, for looking for things.
Oh, right.
Taking splinters out of people's feet.
Oh, right, okay. That makes sense. This is like a household device for children.
Let's just move on.
For sons getting in trouble.
Correct.
Okay. Apple, negative by 1/3 of 1% in the pre-market. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A check on General Motors shares up 1% in the pre-market. They announced a board-approved $6 billion share buyback just moments ago. GM also said that it's focused on improving the profitability of its EV business. Full results for the second quarter come on July 23rd. Donald Trump has met with his probation officer for the first time yesterday, virtually, with Trump in Florida and the officers in New York. It lasted for about 30 minutes. The meeting will help a judge decide how much time, if any, Trump will spend behind bars for falsifying business records. Sentencing for the former president is set for July 11th. Trump and his legal team are already taking steps to file an appeal. And a New York City office building owned by a related affiliate is set to be sold at a steep discount. Empire Capital and Amdar agreed to purchase the property at 321 West 44th Street for less than $50 million, according to people familiar. That's a roughly 67% discount from what was originally paid in 2018. That's your brief, John.
Brutal. And maybe more of that still to come. Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, taking on risk in Europe.
There's coming a point where European bonds are more attractive than Treasury bonds, in my opinion.
We'll talk about that opinion next. Live from New York, this is Bloomberg.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Counting you down to the opening bow this morning. Good morning to you. Equity futures on the S&P 500 just a little lighter, softer, negative, down by 1/3%. A rally in the bond market. Yields down 3 basis points on a 10-year. In the US, we're down to 443.35. You're not getting that rally in France, I can tell you that this morning. Yields are much higher once again on the session over in French trading. Under surveillance this morning, taking on risk in Europe.
I think in terms of an attraction, German 10-year bunds and French oats, the 10-year there, their spreads have narrowed significantly in the past month or two relative to treasuries, and today as well by 8 or 10 basis points. So there's coming a point where European bonds are more attractive than Treasury bonds, in my opinion.
Quite a take based on the price action of the last 24 hours. Here's the latest. French bonds tumbling, on track for their biggest two-day loss since 2020, as the fallout from Emmanuel Macron's decision to call a snap election continues to rattle investor confidence. Ian Steely of JP Morgan Asset Management saying this: ultimately, French bonds have been impacted with the uncertainty and would indicate other parts of Europe, like Spain, will become seen as better credits. Ian's with us around the table. Ian, good morning to you.
Morning.
What is it about this? Can you just explain in very simple terms, what is it about calling a snap election in France that's leading to a reaction like this over the last 24 hours?
So ultimately what we saw over the weekend was we had the European elections. We had a swing more to the right than had been expected, particularly in France. So Macron has come out and said, okay, if that's the case, let's have an election on this. And the concern from a market standpoint is that the right wing, the RN party, actually do gain, more seats, and ultimately they are tax cutters. They want to spend money. This is France that had a deficit of 5.5% last year, total debt to GDP well north of 100%, downgraded by the rating agencies not that long ago. And the market's basically just concerned around it and saying, hold on, if that's the case, why don't we look at other parts of Europe?
So where's the deficit now? Close to 5.5% GDP?
5.5%, and
something like that?
Under European legislation, they need to start bringing it back towards 3%. And that's obviously going to be challenged under this scenario.
France is starting to look more like the periphery.
And if you look at what's happened over the last couple of days or so, you've again seen a tightening. I think Spain's something like 18 basis points higher now than France, and obviously that's significantly tighter than it was not that long ago.
Does it make sense, though, that the yields on, say, French bonds and Italian bonds are jumping up, gapping up relative to German bonds, where essentially they're facing the same type of political threat?
They are, but obviously Germany haven't called the snap election, and also you still see Germany as the safe haven asset within the whole of Europe. I think Italy has been impacted somewhat by effectively just sort of dragged around by what's happening in France, and also Italy is a very favourable positioned market earlier this year just because of the additional spread and yield that you're getting on those markets.
To zoom out and sort of go to where we began with Bill Gross, where he was saying basically he sees European bonds as a better buy than the U.S. debt. A lot of people have been sort of arguing that Europe looks more favorable just simply because the ECB cut first. They seem to be on a rate cutting cycle before the Federal Reserve. Do you buy into that more broadly, despite some of the internecine issues that we've seen over the past couple of days?
I think it's a really interesting question because actually if you look at what happened last week, I think it's a legitimate question is would the ECB have cut rates with the data set that they were looking at had they not pre-announced it a few weeks ago? And I think that's a really good question that is quite, Lagarde says yes, I'm not so sure. So when we look at the European data at the moment, there's definitely sort of green shoots coming through. And actually, when you look at some of the US data, you could argue we are maybe seeing a sign of softening. So I'm not certain that we're going to have a massive divergence between Europe and the US if you take sort of a longer 12 to 18 month period.
Let's run with a single word, convergence or divergence. Which one? Do you see convergence between the two?
I think over a period, I think you do see convergence. Obviously the Fed's late to the party and sitting on the sideways fashionably, but I think they are going to come to the party.
What do you think that means for US bonds relative to what's developing in Europe?
I think what you're going to see is you are going to see the bonds will be dictated by what the central banks do. So then we are back to basically data watching and checking out what happens on inflation prints. Obviously, big one tomorrow. But I see actually US yields looking reasonably attractive on a 12-month time horizon.
You say data watching. Actually, that's not what we're looking at at all. What we're looking at is a building at 321 West 44th Street in Manhattan. I think Lisa indicated a little bit early this morning. PIMCO, what are they warning about now?
Oh, they're warning that a lot of regional banks are still going to fall apart because they are lenders, massive lenders, to a lot of commercial real estate and office space that is yet to really fall out of bed.
So should we be watching inflation or commercial real estate? Which one?
I think in the near term, you want to be watching inflation. That's effectively what the market's focused on. I think longer term, and I think this is what Jerome Powell and the Federal Reserve are looking at, is they are still concerned about these long and variable lags. They've been longer and maybe more variable than people have been expecting, but we still have had 525 basis points of rate hikes, and ultimately we still don't know what the exact impact of that's going to be. So I think that's what Jerome Powell is saying, is hold on, we've done a lot. At some point there are going to be some cracks coming through the system.
I guess this goes to this broader question, and you'd be perfectly positioned to really answer it. And the reason why we bring up commercial real estate with the long and variable lags is because a lot of people said it is improbable, if not impossible, to raise rates this much in the United States, in Europe, without something breaking. A lot of people have said we see the all clear and have been piling into credit. At what point is there a credit risk at a time when we really just haven't seen those cracks? And it seems like a lot of the bigger companies have done just fine. They've refinanced. Everything is hunky-dory. But elsewhere, there certainly are signs of some serious stress.
There are, and definitely some of the lower credit qualities. And if you look at sort of, there's been a big divergence within the high yield market where, yes, the high yield spread on average looks pretty low, but there's still a sort of a 5% bucket, which the market is saying there's some trouble in that space, and they're trading at over 1,000 spreads. I personally think high quality, investment grade yields, they're looking pretty decent, even though spreads are tight. Fundamentally, we see corporates in that area as very robust at the moment. So I do think that people are focusing on the all-in yield and not so much looking at the spread on that part of the market.
You're in New York. Yep. You're normally in London. You're here for the quarterly meeting where you discuss and you hash out all sorts of potential investment views. How much conviction do you have this time around?
I think there's a lot of conviction in my mind that we've got a very reactive central bank set at the moment, who at the first sign of weakness are going to be looking to effectively ease policy. That's what I've heard from all the central bankers really since the pivot in December, is that they have done enough, They feel that they're in restrictive territory. They really do want to ease policy back down again, and they're just waiting for the green light to do that.
On the surface, this might sound like a silly question, but to some people it might sound quite relevant. Do you think the first sign was Friday at 8:30? Do you think we look back on that and maybe see that as a first sign of weakness in the labour market? Are we looking at the right survey, asking the right questions?
I think, obviously, job headline number, very good, but actually if you look at a lot of the survey data that's been happening over the last few weeks or so, whether it's JOLTS, whether it's a small business hirings, whether it's some of the surveys out of the New York Fed about people concerned about losing their jobs, temporary workers as a percentage of the workforce falling. These are all signs. I think weakness is probably too soon. Softening is definitely the right word. And I think it's going to be very key as to whether we continue with these high headline prints or whether actually some of the other data is going to show that we are starting to see a bit of softening.
Mike Apin said the same thing over at Bank of America. What was it, cooling but not cool?
Yeah.
So something like that.
Which is the reason why I didn't see a rate cut, until much later this year. And he felt pretty good on Friday.
When was the last time that we had a jobs print this strong and afterwards saw such widespread skepticism about it? Because usually there's someone in the corner sort of making noise about, it overstates the strength of the labour market, and you're like, yeah, all right, okay. And you always hear those kind of voices. But now it's like pretty much everyone I've spoken to is kind of asking the same question about Friday's data.
First of all, it completely conflicted the household survey versus the other. Second of all, we're conditioned by experience. How many other downward revisions have we seen from pretty big numbers in the past year or two? And this is clearly messier data to get. That's, I think, what's creating some of this skepticism that's borne out to be somewhat correct, not nefarious, not necessarily conspiracy theory stuff, but this has been a tough nut to crack.
You know what TK would say about the news conference tomorrow, right? There's going to be a sheet of paper for Chairman Powell. It's going to have the, answer to any question on the labour market, and he's just going to read it verbatim. Because that's where there could be some trouble. His interpretation of what Friday actually was and where this labour market is.
I think to Ian Steely's point, this is a central bank that wants to cut, and he's talking more globally about all the central banks, but I think you could say it very specifically to Jay Powell. This is a man who wants to cut rates, who is very concerned about some of the K-shaped kind of divergences, and we've seen that pretty much consistently when he's supposed to do hawk, and instead he's just can't resist the dove.
Lagarde clearly wanted to cut so much they can't. And now we're all asking whether they should have. Ian, this was good. Thank you, sir. Ian Steely of JP Morgan Asset Management. The next hour of Bloomberg Surveillance looks a little something like this. Alicia Levine of BNY Mellon. This conversation with Bill Chappell of Truist is going to be fascinating. What was it? Krispy Kreme?
Yeah, Krispy Kreme and Ozempic.
Why we've sort of seen the GLP-1 scare.
Yeah.
We need to move on.
And now go all in, because people are going to go back to Krispy Kreme, especially with a partnership from McDonald's.
Okay, that conversation just around the corner. Mark McCormick at TD and Stephen Stanley of Santander joining us as well. From New York City, this is Bloomberg.
What's it like moving from the East Coast, where everything is finance and money, to the West Coast, where everything is technology? Did you fit in right away? And did you really know how to use all the computer things that they give you to use?
So it was pretty fun. There were plenty of times where I would sit around in meetings and literally I would be Googling terms. And at one meeting, Larry Page actually caught me Googling terms, and he kind of pointed that out to other people in the room, which was a little embarrassing, but I figured there were some things that I could do that they couldn't do. And so it was a learning curve. And my dad always, he taught me at a young age a term that I've used constantly with my teams. He said, in his lab at Stanford, if a physicist could not define a quark in under 30 seconds, they didn't know what they were talking about. And so I use the quark test all the time. If somebody's rambling on and they can't get to the point, they probably don't know what they're talking about, they fail the quark test. My finance team knows this quark test. And at Google, I'm working with amazing computer scientists, so they never fail the quark test. They can explain things really clearly, which shoots you up the learning curve.
But did you understand what they were talking about from the beginning, or did you have a special tutor that's taught you technology? Or did you?
I had actually run tech banking and took Google Public, so I had a little sneak preview.
It's the world's second